9 a.m. here in New York City. I'm Shauna Smith alongside Brad Smith. This is Yahoo Finance Live, and here's what we're watching this morning. The Fed's final rate decision of 2023 is due this afternoon. A pause is all but certain, but the path ahead, not so much. Chair Jay Powell is expected to push back on the market's rate cut expectations for early 2024.
Plus, Tesla recalling more than 2 million vehicles around issues with its self-driving feature. It's Tesla's second autopilot-related recall this year, part of an ongoing federal investigation into the safety of the company's driverless systems.
And a massive deal for the planet. Almost 200 nations agreeing at COP28 to, quote, transition away from fossil fuels. While it's the first deal of its kind, it's not quite the phase out that many had been pushing for.
Well, all eyes are on the Federal Reserve's policy and their monetary policy decision. The central bank widely expected to hold interest rates steady this afternoon during its last decision of the year. The Fed remains committed to the goal of bringing inflation down to 2%, despite officials warning rates could remain elevated for some time. Investors, however, expect the central bank will pivot in 2024. So how likely is it that the Fed and investors can finally get on the same page? Yahoo Finance's Jennifer Schonberger has the details. Hey, Jennifer.
Good morning, Brad. Fed officials just reconvened moments ago here in Washington for the second day of their two-day policy meeting, where, as you said, they are widely expected to hold interest rates steady, but try to peel back Wall Street's expectations for 100 basis points of rate cuts priced in next year. While the Fed may be content to hold rates at current levels, Fed Chair Jay Powell likely won't signal this afternoon that the central bank is done and take the possibility of rate hikes off the table, even if they don't intend to use them. Officials want to prevent financial conditions from loosening for the economy to continue feeling its tough medicine to bring inflation down and to walk back expectations for rate cuts. The Fed will release new interest rate projections, that so-called dot plot, where investors will get an eye into how many rate cuts the central bank is penciling in, as well as estimates for their inflation outlook. So this is another area where the Fed could use to signal to markets fewer rate cuts next year. Back in September, the committee penciled in 50 basis points of rate cuts, but that was coming from a higher level on the Fed funds rate. Now, Fed Chair Jay Powell expected to strike a hawkish tone this afternoon in the press conference, where he's expected to reiterate a message similar to the one 2 weeks ago, where he warned investors not to get ahead of themselves, to assume that the Fed is finished raising rates and will soon pivot to rate cuts. This policy decision coming down at 2 p.m. Eastern, followed by Fed Chair Powell's press conference at 2:30. Back to you.
All right, thanks so much, Jen. We are looking forward to that. Let's talk about where things stand today, because while there's basically no doubt from strategists, economists, and investors that the Fed is done raising rates, there is some debate about how early and how aggressive the central bank is going to potentially cut rates in 2024. Following Tuesday's inflation report, traders trimmed their rate cut expectations after the latest inflation data showed that the Fed is still a far ways away from getting to its 2% target. Fed swaps now pricing in the first rate cut likely in May. For more on this, we want to bring in Jack Manley. He's JP Morgan Asset Management Global Market Strategist. Jack, it's great to see you in person. Yeah. Once again, let's talk about what we will likely not so much hear from the Fed and hear from Jay Powell this afternoon, but really looking ahead to 2024, because there's so much expectation, so much optimism around the fact that the market seems confident the Fed is going to cut in the first half of next year. Do you agree with that sentiment?
I don't necessarily agree with that sentiment, and I think that the Fed is pretty keen on this, embracing this narrative of higher for longer. You know, we've seen ample evidence, including yesterday's CPI print, that inflation is well on the way to achieving that target of 2-ish%. But there is still more room to go. And what I think is important to remember here is that moving from 9% last year to 3% this year, that was the easy part, right? That was supply chain issues getting resolved. Now moving from 3% down to 2%, that's going to take a lot more work. And the concern I have is that there's too much excitement about the timing of the first rate cut, that they're going to be that the market is anticipating too many rate cuts next year, and I think there is a little bit of room for disappointment in that, frankly. Okay,
so with regard to that, I mean, we're already looking at some of the earliest calls for a rate cut coming as early as perhaps the first quarter in 2024, taking that off the table and kind of getting more into the frame of mind that you have. If we were to see rate cuts next year, when do you think they would begin?
Yeah, If we see rate cuts in the first half of next year, it is because something bad has happened, is my view on this, right? It is an indication that the economy has deteriorated in a certain way. Unemployment has spiked. GDP has meaningfully decelerated. That has forced the Fed to move more aggressively than initially anticipated. And that's bad news. We don't want to root for early rate cuts. We don't want to root for more rate cuts next year. We want the Fed to be able to take its time, because if it's taking its time, it means that nothing is broken yet. In that vein, Brad, I'm thinking back half of next year is when we start to see interest rate cuts. I'm looking for roughly 25 basis points of cuts per meeting, which adds up to maybe 3 or 4 cuts in the back half of next year. So
consecutively?
I would say probably consecutively. Call it 75 to 100 basis points, but sort of backloaded into the second half of 24.
So then, Jack, what does that mean then for the equity markets, at least in the first half of the year? If the market's a little bit too optimistic in terms of maybe the fact that they do think the Fed will likely cut rates, does that mean that we should expect more volatility in the first couple of months?
Volatility is the name of the game. You know, if you think about what has been happening to markets so far this year, it has been driven overwhelmingly by a very small handful of names, right? We spent a lot of time talking about the Magnificent Seven. And a lot of that, of course, has to do with what's going on with AI, a lot of it having to do with these sort of somewhat miraculous seeming weight loss drugs, these GLPs, right? But a lot of it also has to do with this assumption that the Fed's going to start cutting, it's going to start cutting soon, and it's going to start cutting aggressively. And so I think there is room for some of that outperformance recently to unwind. But the story that we have been sort of pounding the table on over the last several months has been opening up the opportunity set a little bit and remembering that there are another 490 plus names in the S&P 500 that haven't done a whole lot of anything. So it's volatility certainly in 2024, but I think a really ripe environment for good active management across style boxes, across sectors, finding those names that are reasonably valued, that are punching above their weight class from an earnings contribution perspective.
And so I think that's what our viewers are wondering too, right? At the end of the day, how can they still make sure that they're seeing a return on investment positively, even in volatility? What is the top strategy that you would be employing next year?
Well, I can't believe I'm saying this honestly, Brad, but like my number one conviction in 2024 is high quality, intermediate duration fixed income, right? Call it 3, 5, 7 years, kind of the belly of the curve. It's just enough duration where if you get the call right, you make a boatload of money. If you get the call wrong, you're still kind of getting paid to wait because of the coupon cushion. We haven't seen a fixed income environment like this in a very, very long time, and so why not embrace it? I think there is also a sense of urgency associated with fixed income investing right now, because we have to remember that when the Fed starts cutting rates, and it will start cutting rates, it's going to continue to cut rates through 25, through 26. And in 2025, in 2026, the fixed income market is not going to be attractive like it is right now. So it very much is kind of a strike while the iron's hot type investment strategy.
What about, though, when you take a look at equities? You mentioned there, going back to the fact that you expect at least, or hope to see, more participation from the other remaining companies outside of the 7 that have really dominated the market action this year. Within some of those sectors, who do you think, if you're taking maybe a more defensive approach to that, who is the best positioned in your view?
You know, I think that the large cap banks are in a very good position. That hasn't really played out in performance necessarily, but I always like to lean back on what's going on with net interest margins. And even as the Fed starts to cut interest rates, you are still looking at a very, very healthy spread there, because none of those rate hikes were passed through onto your checking account. None of them were passed through onto your savings account. And with a lot of the regional banking turmoil that we saw earlier this year, the big banks have been that much more capable of defending those ultra low yields that they are paying to their depositors. So a ton of money to be made in this environment, even when rates are moving lower from Fed policy. So that, I think, could be an interesting sector to play.
What do you believe the Fed says today? What's the tenor that they have to strike in order not to spook the markets overly?
They're going to have to toe a line here, and it's going to be very, very difficult to make sure that markets don't get spooked. But you know what? We forget this. But the Fed's job is not to manage the market. That's not what the Fed is here for. Right. And it shouldn't think that way. The Fed has an economic mandate, maximum employment, price stability. That's what it answers to Congress with. And so I don't think the Fed should be paying too much attention to what the market does. Reality says that they will, right? So my guess is that you do see Powell acknowledge that a lot of progress has been made on the inflation front, that you have seen some cooling in the labor market, but that it is still quite a strong economy, right? Because they want to set the stage for this soft landing. And I think we need to gradually push out that first rate cut, to make sure that everybody kind of slowly gets acclimated to this idea that we're not seeing aggressive cuts in the first quarter of next year.
Jack Manley, JP Morgan Asset Management Global Market Strategist, joining us here in studio. Thanks so much, Jack.
Thanks
Great
a lot.
to see you. Well, more trouble for Tesla is coming. The EV maker is recalling almost all of its cars sold in the U.S., totaling over 2 million across its lineup as it looks to fix an aspect of its autopilot system. Now, this comes after allegations from the NHTSA over several accidents here. You're taking a look at shares pre-market. They are down by about 1%. Now, what's always interesting is whether some of the recalls that take place with Tesla are something where they can just make an over-the-air update, or where people, owners of the vehicles, would actually have to bring those vehicles into a service center here. That's what makes it all the more important to track this one specifically, because one of Tesla's biggest marketing components has been self-driving at the end of the day, or FSD. So with that acronym becoming household known at this point, and it being one of the biggest marketing elements that Tesla and Elon Musk have continued to put forward out there into the market of potential EV buyers, this is another major hiccup in that messaging in order for them to kind of deploy and then ultimately get back to kind of good graces at a time where we're already seeing some of the changes in expectations and production for a lot of the other legacy automakers too.
Yeah, Brad, this also goes back to what we were talking to Colin Rush about yesterday from Oppenheimer, and we were mentioning the fact that there was Washington Post analysis out talking about the fact that there had been 8 crashes. They had found 8 crashes at least, or of instances where people have been driving the car were either killed or in a serious condition after those crashed. And they were pointing to the fact that many of these vehicles had used the autopilot system in areas where Tesla had deemed it not reliable. So when he was talking about that, the reason that we were bringing it up from an analyst perspective, where we were asking him about whether or not this shakes the confidence of some people who are thinking about buying Teslas, thinking about buying those vehicles. And he said, yes, that it is a short-term risk here, at least over the coming months until we get a bit more clarity. A lot of that on regulators in terms of what exactly needs to happen from a transparency point of view. But I bring that up because that obviously can translate into demand for Tesla. And we know Tesla demand has been struggling just a little bit. They have been forced to lower prices here in the U.S. and abroad in order to boost that demand. It's not only a Tesla problem. We're seeing it also play out from GM, from Ford, from some of the legacy automakers in terms of that waning demand, or maybe demand not meeting the initial expectations for EVs. So the fact that we are seeing more trouble here is a bit of a worrisome sign for Tesla. But again, I think it's how quickly they're able to resolve these issues and move past it, and also just win back that confidence that maybe they had lost from some customers.
Yeah, sounds like they will be issuing that software update.
Yes. All right, Brad, well, let's talk about another headline here involving Elon Musk's other companies, one of his other companies, and that is SpaceX, reportedly getting a boost in its valuation, according to Bloomberg. And when you take a look at what we are seeing here, the rising valuation that this would hold, I believe it was about $97 a share. The valuation would be near $180 billion. That was due to the latest tender offering, all according to Bloomberg. But the rising valuation is a sign of strong investor demand, I think, just in terms of the positioning and the want for investors to have this stake in SpaceX. It has been pretty successful when you take a look at the number of launches that they have done just this year. More than 90 successful launches of its Falcon 9 and Falcon Heavy rockets this year. Currently, I think, very well positioned when you compare it to Blue Origin and also what we've seen from Richard Branson's company. And then a reminder that we were talking about not too long ago, the fact that Richard Branson said that he's not putting any more of his own money into his company. So when you kind of take the fact that maybe some of the competitors are taking a step back, SpaceX very well positioned, I think, in this race.
Yeah, for SpaceX and what they've been able to do within the Starlink business as well, launching satellites into orbit in order to power some of the high broadband or high-speed internet into some of the rural areas in the world. At the end of the day, I mean, it's actually great science. It's great deployment that they're looking at here and being able to move forward with. It's a, I think, larger question of what the early investors into SpaceX, some of those private investors, are now looking to get in a return in advance of the company weighing potentially. There have been multiple reports about whether or not they would actually weigh an IPO of SpaceX in entirety, or spin off Starlink, have that be its own IPO. And so there is, I think, even more of that brewing spirit among some of those early investors to push the leadership at SpaceX to say, okay, we need to figure out within this large valuation, this, I mean, it's beyond decacorn at this point, what, hectacorn? We're getting into mythical creatures we don't even know anymore. But at the end of the day, getting to such a valuation, a lot of those investors are going to want to realize returns at this point.
Yeah, and I think just the rumors of the IPO, it also just goes back to the fact that they're trying to capitalize off of this excitement that we're seeing play out surrounding SpaceX, especially surrounding Starlink. Exactly how they do it, if they were to IPO, I think is the big question a lot of those early investors are asking right now.
Spot on. Also, in Musk world, X, formerly known as Twitter, is taking a hit from lack of ad revenue. The social media company is reportedly on track to generate $2.5 billion from ads this year. That's far below its 2022 performance of over $1 billion per quarter, according to Bloomberg. Here you're taking a look at some of the expectations versus what they were seeing on a 3-month basis. At the end of the day, $44 billion is what Elon Musk paid for this company, made some radical changes, tried to make it so that they were monetizing more portions of the platform, and quite aggressively so. When you uproot so much of the model that was already there that users had come to expect, and for advertisers, they had come to expect a certain amount of engagements taking place on the platform, different ability to ultimately advertise in a realm that did not have as much hateful content, divisive content that was just running amok on it. I think that's one of the issues that advertisers are pointing back to as well here, just the uncertainty of where their visuals are going to lay or sit within that platform in the realm.
Yeah, and I also just think Musk's tweets really have been scaring off advertisers here just in terms of the reliability, how much they should trust in terms of the placement of those ads. And it is a long list of names of companies that are no longer advertising on X. And just to bring up some of those that decided to suspend their advertising recently, you have Disney, you have Paramount, Comcast, Lionsgate, NBC, Universal, Warner Brothers, Discovery, as CNN parent there, all suspending their advertising on X for a period of time. And we have seen Musk under a bit of pressure, I think it's fair to say, just in terms of the comments that he made at the Deal Book Summit, the fact that he was blaming almost everyone else but himself, not taking accountability, calling out Bob Iger essentially by name for calling him out, just saying that he would be the reason why we are seeing the fact that X is struggling so much. So the fact that ad revenue down substantially here, falling to $2.5 billion, I don't think a huge surprise from those who have been closely watching this story.
Yeah, not great to cuss out your customers at the end of the day.
No, never a good move. We'll leave it there. Yeah. All right, guys, let's get to another Vegas story, and that is Foxconn doubling down on its investment in India. The largest iPhone supplier gaining approval to pour at least $1 billion into its India plant. That's in addition to the $1.6 billion that was already planned. This is all according to Bloomberg. Yahoo Finance's Dan Halley joining us now with the details. And Dan, this is just the latest report here showing that Apple at least seeing India playing a critical role in the company moving forward.
Yeah, look, this is just going to be a story that continues to kind of spread across the tech ecosystem. A lot of companies set up in China, they figured there's easy revenue there, there's easy employee regulations, so we're going to be able to go in there. But as China has, increased the salaries for workers, the tensions with the U.S. have gotten worse. After the pandemic, during the pandemic, we saw the shutdowns. It's all kind of been just a stew for these companies. Not a good one, by the way. This is one that it's been sitting for a few weeks, so not a great stew. So these companies just want to find a place that is more business friendly and doesn't have the potential risks that China has to offer. And so they continue to move into India. By the way, India is the second largest smartphone market in the world outside of China. So they would be able to get more customers there. They would be able to get more workers there. And so that's what we're seeing. It's not exactly as easy as just setting up a new shop in China. You have to deal with infrastructure issues. You have to ensure that you're abiding by the rules set up in different districts in India. Also, part of the reason they're setting up, or they originally started setting up the ability to build there, was because in order to sell, they needed to do that as well. So now they have that. It's not just India, though. We're going to start to see other countries get more action when it comes to building out. And there was, I believe, a Wall Street Journal story that had said by the end of the decade, India itself will be responsible for 1/4 of all iPhones made. Also, big thing to point out here is that for the iPhone 15, usually what would happen was Apple would get the products from China and then ship them out, and then the ones in India would come out after that. But in this, with the iPhone 15, the ones made from India went out along with the ones from China. There was some backlash from some Chinese citizens who, wanted to have only China make the phones. But I mean, look, this is Apple. They're going to do what they're going to do.
They're going to do what they're going to do. And I guess good news here for India, just in terms of the amount that has already been poured into the country. And then when you take into account the fact that they want to diversify and hedge their bets here against China, likely that we will see more of that. All right, Dan, thank you. Well, COP28 ending on a historic note, almost 200 countries agreeing for the first time to transition away from fossil fuels in a major move to combat climate change. Now, the president of COP28 praising the deal, but stressing that the need for nations to follow through and potentially do more.
Is only as good as its implementation. We are what we do, not what we say. We must take the steps necessary to turn this agreement into tangible actions.
With more on the details of the agreement, we want to bring in Yahoo Finance's Rick Newman. And Rick, I think the big question here this morning is, how much of this is really a landmark deal, or is it really just a change in sort of the language that we're seeing surrounding the deal?
Well, there's definitely some breathless reporting out of Dubai, because this is the first time the language has said something like transition away from fossil fuels. So it's nice that they can agree to this. And what's supposed to happen now is every country is supposed to come back within a period of time and say, here's how we plan to do this to transition away from fossil fuels. That's the difficulty right there. And we're seeing that here in the United States. President Biden has signed into law last year this huge set of incentives for green energy, and some of it is working and some of it is not working. So, for example, we're seeing a big pullback on the installation of wind plants offshore because they're turning out to be very expensive. Interest rates have gone up, made them, in some cases, money-losing projects, and there's a big pullback there. Electric vehicle adoption seems to be plateauing here, even though there are incentives for that. So that's part of the difficulty. And I would point out that economists and many climate experts say the best way to incentivize a real transition away from fossil fuels is a carbon tax. But we don't have a carbon tax here in the United States. We probably never will, because any politician who voted for that would get voted out of office. So while there is growing awareness of climate change and the need to do something about it, there's also resistance to anything that will raise costs on ordinary consumers here in the United States, and also in parts of the world that are sort of like just getting started. The developing world is saying, we're not the ones who put most of that pollution up there. It's the United States and Europe and China and Japan. So we shouldn't have to bear the same burden as everybody else. So I think we're just going to go back after this meeting to the same trudge to try to figure out how to actually implement these things.
Rick, also turning our attention to Washington while we have you, where climate-conscious investing is in focus. A House panel subpoenaing the investment firms and communications around ESG funds. It's part of a larger probe into whether ESG investing violates antitrust laws. What can you tell us about that?
Right. So ESG investing, the ESG stands for environmental, social, governance. I mean, the idea is you're supposed to find these white hat companies, these do-gooder companies, and invest in them. I'm not sure in the first place it's a great investing strategy. There are some questions about that. But this is a hobby horse of some of the conservatives in the Republican Party. This is so-called woke capitalism. They're trying to attack woke capitalism. This just seems to pop up every now and then. I would point out that the House, which is going to hold these hearings, has some important work to do, like get the government funded and do something about aid for Ukraine and Israel. But, one of their sort of showboating priorities is to hold these hearings into woke capitalism. This war on woke capitalism is not going anywhere. I mean, most Americans don't really react to it one way or the other. They don't really care. But it is just something that some Republicans think they need to hammer. So we're going to get another, what I would argue is a fairly pointless hearing on this.
Showboating in Washington. No, Rick, come on
Yes.
now. Never. Rick, appreciate it.
Bye, guys.
Thanks. Well, stocks in China taking a hit this morning after leaders' economic roadmap for 2024 failed to excite investors. Chinese officials named industrial policy a top priority for the new year and failed to announce any large-scale stimulus or extra efforts to mend the faltering property sector. With more on the markets and the reaction we're seeing, and joined now by Jared Blicker. Hey, Jared.
Thank you, Brad. A little bit of disappointment here. There weren't high expectations, but there was really nothing to address the property sector problems that China has had. This was a meeting of the Communist Party's economic, and this is an annual event, Economic Work Conference, and they put out a few objectives. They want to build an industrial system. That's a quote. 2023 was a year of opening up, reopening up, and also stimulating demand, but next year is going to be focused on industrial and building up that sector. Let me go to the Wi-Fi Interactive. I have a couple charts here. The first is Chinese GDP. This goes all the way back to 1992, so 30 years. You can see some volatility here around the pandemic, but it is now around 4.9%. Worthwhile noting that only a week or two ago, Moody's downgraded the outlook, not the debt, but the outlook for China's debt. And it was based in part on unrealistic growth expectations. They're looking for a growth of maybe 3% over this year and the next year, and then 2.8% after that. But it's been difficult for China to stimulate demand because they don't want to devalue their currency. And yet, that's kind of what the nature of printing money is about. So they're trying to do it very targeted, and not do any blanket stimulus. Here's another chart. This is China, their budget deficit relative to GDP. This goes back a decade, and you can see it is at the highest amount. And the reason it's notable, it is above 3%. It was thought that 3% was a ceiling before, but now China has kind of uncorked that bottle, and they are experimenting with higher debt. And all of this has a feedback loop into their currency and also the stocks. And let me just show you what's happening pre-market. The background colors here where you see the green and the red, and that's yesterday's price action, but these little rectangles like Pinduoduo, you can see that's up or down 83 basis points in the pre-market. Alibaba down 0.7%. And let me just show you what's happened year to date in these issues. I'm going to pull off the pre-market quotes. You can see very much a bifurcated market. You have big winners, big losers. Pinduoduo up 80%, Alibaba down 19%. And over the last month, I think this is notable, when in the US and the rest of the world has been screaming higher, we've seen mainly negative price action in China. So China is just kind of decoupled from the rest of the world, although that's not a new event. And the latest measures from the Communist Party certainly not doing anything to stimulate excitement in the investment sector in that country.
Certainly not, and we're seeing that reflected in today's action. All right, Jared Blicker, thank you. We'll keep right here on Yahoo Finance. We got much more of your market action ahead. We'll be right back. Taking a look here as we count down the final seconds to the opening bell on Wall Street, it is going to be a big day here for the markets as we look ahead to the Fed decision and Fed Chair Powell's press conference here later this afternoon. Of course, all eyes are going to be on what Fed policy could potentially look like heading into next year, since it's pretty much a sure bet at this point, at least from traders' perspective, that the Fed is likely to keep on the sidelines, to keep rates as is at the meeting this afternoon. But taking a look at how things are opening here ahead of the Fed meeting, all three of the major averages, we are seeing some movement here with the Dow just right around the flat line, the S&P just slightly above, and the NASDAQ here shaking out as we wait for the opening trade there for the NASDAQ. But the Dow at least under some pressure, if you can call it that, off just about 4 points right now. Let's get over to Jared Blicker for a closer look at some of these moves. Jared.
A whopping 4 points, Shauna. These are sleepy days, at least in the morning. 2 p.m., forget about it. We're going to see some fireworks then. And 2:30, when Powell addresses everyone from his podium, that's going to be the event to watch today. But we're seeing everything slightly in the green. NASDAQ leading up about 0.2%. Small caps actually higher a little bit more, about 0.3%. Here's the sector action. Tech is in the forefront. That's up 0.4%. Real estate, consumer discretionary, and also energy. Those are the outperformers. To the downside, we do have some losers. Taking a look at materials, that is the biggest, down about 1.2%. Healthcare also down about 1/3%. And let's take a look at the NASDAQ 100. We did say that tech was leading, and we can see the mega caps largely in the green, except for Tesla. That's down 1%. Interesting situation regarding the NASDAQ 100 rebalance that takes place after the close on Friday, set for Monday morning. We did see some selling in the mega caps because it looks like there's going to be reduced concentration in them, and that's from the overseers of the NASDAQ 100 index. Vertex up 6%, but not seeing a lot of dark green, dark red outside of that. And we want to take a look at the EV space. I was noting Tesla under a little bit of pressure today. Xpeng, a Chinese stock, that's down 4%. Other China stocks that we just talked about not doing so well. Looks like Toyota down 0.4%. GM also right there with it, and Ford down 1%. And let's take a look at the energy sector, which has been lagging recently. Crude oil has just been in a steady march for something like 8-10 weeks in a row. But we are seeing some green today. Shell notwithstanding, and BP. We do see Exxon just playing around with the unchanged line. So is Chevron. And it looks like ConocoPhillips up about 0.6%, guys.
All right, good scan across the market to start off today's trading session, Jared. Appreciate it. All eyes are on the gaming space this morning as well, including Roblox. Wells Fargo initiated coverage on the company today with an overweight recommendation and a $49 price target. For more on this, Yahoo Finance reporter Madison Mills here with us. Hey, Maddie.
I mean, the gaming industry is so impacted by Fed Chair Powell's remarks that, of course, I have to start the day by talking about this, guys, obviously. But this is a big deal because Wells Fargo is initiating their coverage on Roblox for the first time, which gives some credibility to this name, which has already had quite a bit of credibility because of their performance year to date, which we'll get to. But going through what's led to all of this green you're seeing on the screen for Roblox that has come out of this note from Wells Fargo, they're saying don't look at this as a gaming platform, look at it as an audience platform. And we know that the more eyeballs a platform has, the better that's going to be for advertisers. And that's what Wells Fargo is focusing on. Guys, I also thought it was really interesting. In the note, they talk about the outcome of that Epic versus Google lawsuit coming out of San Francisco, saying that any improvement in App Store fees is a bullish indicator for this stock. So I thought that was really interesting. And they talk about, again, that price target of $49. This is a stock that's already up 48% year to date. We've got 68% of analysts saying it's a buy, only 17% putting it at a hold. And from a technicals perspective, the movement that we're seeing in this stock, still in the green this morning, but it was up over 2% in the pre-market. That triggered, from a technicals perspective, clearing a buy point for this name after that upward motion. The relative strength line for the stock also spiking this morning as well. So a lot of bullish indicators there.
There are a lot of bullish indicators there. I'm happy you called out what they were saying there about the Epic and Google of ruling yesterday, because we certainly did see that play out in yesterday's trading, just in terms of some of the movement that we saw in these gaming stocks, not just Roblox. Take-Two also viewed as one of the beneficiaries there when you take into account the portion of the revenue that they're getting through mobile. But Maddie, how does Roblox, do you think, stack up to the demand that we're we're seeing more broadly across gaming. Because when you look at these numbers, 20% growth in daily active users from a year ago, it's pretty impressive when you take into account the fact that we saw a massive surge in gaming during the pandemic.
Right, it is impressive to continue that growth, and that's what the street obviously wants to see earnings call after earnings call. But the challenge for them is that that's not necessarily translating to profit margins, and that's what the street is going to be mainly looking for. And that's why Wells Fargo is sort of banking in this note on the advertising space being a boon for this name moving forward. But since you mentioned Take-Two, I do want to do a little bit of a comparison here between Roblox and some of their competitors. Take-Two is outpacing this name year to date and has been outpacing it for the past couple of months, but Roblox outpacing Nintendo, for example, year to date. Still some analysts saying that a Nintendo name is a little bit more reliable, obviously, a little bit of a safer play in comparison to some of these newer names here. I also want to mention Hasbro, because a name like Roblox coming in, taking a little bit of market share away potentially from a company like Roblox. Obviously, poor Hasbro really having a tough year here and laying off 20% of their staff earlier this week. Guys, back in 2021, Hasbro and Roblox had a product deal, and I feel like maybe if they had continued on that, these two could have helped each other. The stock market loved that for both of those names, and now not so much for Hasbro here heading into Christmas.
Yeah, back in like 2014, GameStop also had a cloud gaming unit called Spawn Labs, and only if they had continued in that effort.
Right? I know.
Hindsight's always 2020.
There you go. Yeah.
Madison Mills, thanks so much. Appreciate
Thank
it.
you.
Well, D.R. Horton is rallying today. KBW upgrading the home builder to outperform. That's up from market perform with a $164 price target previously. The firm saying increasingly positive housing supply and demand is good for home builders, and that, quote, they have more room to run. And there you're taking a look at what they're also saying about the current housing supply and dynamics. Ultimately, here at the end of the day, it's still a larger story about the mortgage rates that people are being able to lock in for a new home that is the larger driver of some of the home buyer confidence out there too for new homes versus some of the existing homes, even so. And then additionally for a lot of the home builders that are out there as well.
Yeah, I think just the dynamics that are playing out in the housing market is almost unprecedented. We've heard that from so many of our guests here over the last several months. And when you take into account that, 70 to 80% of homeowners right now are locked into rates that are at or below 5%. They're in no rush to move in this type of environment, even though we have seen some improvement in the 30-year mortgage rate down now just around that 7% level. Still, though, people are choosing to stay in their home. So that's putting the pressure, and it's also an opportunity here for so many of these home builders. When people are not staying on the sidelines, there is still some demand to buy right now. The home buyers that are out there, potential home buyers, almost have no other option or limited options in the existing home space, and they're turning to home builders, new homes, in order to make that purchase. So I think we've seen this massive rally, and a lot of these home builder names, you're seeing it on a 5-year chart, but even if you take into account the massive rise that we've seen since the start of the year. Yes, of course, if we do see the Fed stay on pause and potentially cut rates, that is a bullish sign here for the housing market going forward. So even more optimism potentially as you look ahead to 2024. All right, well, data out this week showing that while inflation is slowing, rent inflation increasing by 0.5% after rising 0.3% in October. Now, with mortgage rates falling for the 4th straight week, but still holding above 7%, prices are near record highs, and potential home buyers, well, they are getting priced out of the market. Many of them are, and they're being forced to rent. So what's ahead for housing next year? We want to bring in Bruce McNeilage. He's the CEO and co-founder of Kinlock Partners. Bruce, it's great to see you again. So talk to us just about the dynamics that are going on right now within the rental space. We are still seeing, it's interesting when you take a look at the data that we got from CPI, comparing that to what we're seeing in the private markets, where we are starting to see this deceleration in rental prices. I'm curious, what are you seeing from your perspective, and is there any relief in sight?
So in the single family rental business, we are not seeing any slowdown. We're about 98% occupied in Kinlock Partners portfolio, and the industry on a whole is 98% occupied. We are not raising rates as high as we have in the past on a percentage basis, but rents continue to be flat, if not up a little bit. And so that's making it more it's tougher to get a house. I mean, it's more expensive to get a rental house, and it's also tougher to buy a house.
And also, I mean, this week we had Scott Sperling, co-CEO of THL Partners. This is what he had to say about the availability of homes, and this directly correlates with the rental market as well here. Just want to play this out for you.
You have this very funny situation where if you have a mortgage that was set at the lower rates, you're not going to move, and you're not going to try to swap out. And so supply, which you would think would be growing, is not growing. It's actually shrinking of available housing at the same time that you have people who require expanded housing or would like to have expanded housing. And so you have this very funny supply-demand dynamic that doesn't necessarily reflect the underlying cost of new housing.
Right.
And that I'm not sure I've seen that in the last 4 decades.
And so, Bruce, it's clear that this is going to be one of the stickier elements of inflation. I mean, if you game this out for multiple years, even given what people are locked into, what are some of your expectations more long term?
So we are not seeing people move, as he said. If you have a 3 or 4 or 5% mortgage, you can't move. You're locked into that house unless you want a significantly higher payment. So people are staying put. Really, where the sales are is the entry-level home buyer from the new builder. And builders are doing great as far as supplying houses, but they can't meet demand. Demand is so much higher than what these builders are able to offer to the general public. We are millions and millions of houses short in this country. And quite frankly, it makes it tougher and tougher. Price of houses are going up, the rent's going up because it's a supply and demand issue. There's just too much demand and not enough supply.
So Bruce, do you see home prices heading even higher as you look ahead to 2024?
Yeah, they're not gonna go down. That's for sure. And mortgage rates might go down, but if the cost of a house goes up $10,000 or $20,000, it's a wash. The payments are going to stay the same. So I keep hearing interest rates are going down, but I don't hear too many people saying, yeah, but the price of houses are going up, and so it's going to be a wash.
To what extent do you believe that home builders will need to offset some of the rate pressures that potential buyers might be anticipating?
So home builders are doing very well in offering something that's helpful to buyers, and that's a buy down, a 3-2-1 or 2-1 buy down, where they're giving you a much lower rate the first few years, maybe 4 or 5%, but then that rate's going to jump up in the second or third year, again making that payment higher than the buyers probably had budgeted for or want to pay. First couple of years, it works great, but long term, the buyers are still going to have a higher payment because of the higher interest rate.
Bruce, we got to leave things there on the day. Bruce McNeilage, who is the CEO and co-founder of Kinloch Partners, thanks so much for taking the time. Well, let's take a look at some trending tickers this morning. We start things off with Pfizer shares falling this morning after the pharmaceutical company warned revenue could head lower in 2024. That's thanks to a continued slowdown in demand for COVID vaccines and related products. Yahoo Finance's Anjali Kamlani is here with us with more on this story. Hey, Anj.
Hey guys, that's right. In addition to the slowdown in COVID vaccinations, the company is also facing pressure with its acquisition of Seagen, that $43 billion deal closing today, or rather tomorrow. And that is when it will start to integrate and be part of the Pfizer portfolio. It's an end-to-end oncology play for the company, which gives it about $3 billion for next year, Pfizer said in its report today. They're also looking at the addition of the COVID products, or rather the addition of Seagen without COVID products. They're really discounting the impact of the lower COVID products sales next year. So if you take a look at that, they're anticipating a total of about $8 billion for the COVID products next year. And that's about what Paxlovid is about to bring in alone just this year. So significant decrease, really decreasing the total outlook of Pfizer legacy to about $50 billion for 2024. And that's really about half of what it was in 2022, if you remember that record year they had. So definitely seeing that pressure from lowered COVID sales. Meanwhile, revenues are about 3 to 5% estimated without Seagen or COVID products, and 8 to 10% with Seagen and without COVID. So they're really, like I said, really looking outside of COVID for the upcoming year.
Yeah, Naj, as we see a number of these pharmaceutical companies, a number of the names in the space kind of reposition their businesses as you look ahead to so many of the changing dynamics right now going on within the healthcare space. There's also some headlines out from Walgreens, right? Boots Alliance looking to maybe revive some of those spin-off talks that they had been maybe mulling before. This is all according to a report from Bloomberg. What can you tell us there?
That's right. Bloomberg letting us know that those discussions have been revived, and it could be either an IPO for Boots, which operates 2,200 locations in the UK, or it could be a sale, which is what that discussion had been last year. Recall that Walgreens Boots Alliance formed in 2014 when Walgreens purchased its remaining 55% stake in Boots. And this is part of the strategy that the company is taking as it shifts and pivots to what we see kind of in CVS, its main competitor, which is more of a healthcare strategy. They're looking to really make acquisitions and make moves. You saw the incoming or the new CEO, Tim Wentworth, a legacy healthcare person in that space. And it's interesting timing too, because Moody's also downgraded Walgreens yesterday, really hitting them with a junk rating. And that is something that Walgreens says that they are disappointed by, and that they feel that they haven't been given enough time to kind of prove this strategy. And they're looking to make that point in the upcoming year. So they, like they said, quote, remain confident in the company's future and ability to deliver greater value. We know that pharmacies in general, drug chains in general, have been under pressure for the last several years pre-COVID. They really did get that COVID boost when it comes to the vaccinations and the flow of volume in their stores. So that is starting to wane. We're starting to see those pressures build back up again. And Walgreens is positioning itself into more of a broader healthcare sort of a strategy versus, the Rite Aid closures that we've seen. So will be interesting to see if this plays out, if Moody's change their mind once they see this in play.
We have Walgreens shares off just about 45% over the last year, right, Anj? Thank you. We are also taking a look at Take-Two Interactive, the video game developer, making its way into the NASDAQ 100 index. Take-Two will be replacing CGen. We were just talking about the acquisition there from Pfizer from the tech-heavy NASDAQ. These changes are effective prior to the opening bell on Monday, December 18th. It's offering a bit of a boost here to Take-Two shares. You're looking at gains of just about 3%. Of course, we're seeing a continuation of the jump that we saw yesterday on the heels of that ruling in the battle between Google and Epic Games. That ruling also looked to position or viewed widely pretty much as a big win here for Take-Two Interactive, just given the fact that they get so much of their revenue from mobile gaming. But the inclusion in an index like the NASDAQ 100, obviously good news here for any company.
Yeah, that means anybody that owned the NASDAQ 100, they're going to own Take-Two Interactive, whether you like it or not. But I think a lot of people out there, they've got a few things to like. The stock is up, and of course, past performance does not equal future results, but the stock is up year to date by about 57%. You've got GTA. They hit that button in this most recent earnings report here. And then at the end of the day, looking out to the entire pipeline of games and where they can continue to lean into some of the title strength that they do have. I think the entire console type of mix that's out there is also becoming a little bit more flat here, especially as there are more requirements as a result of the Microsoft Activision deal, even for there to be more ability for gamers to be able to play specific titles across consoles. And I think acquisition put that squarely into focus, because you had a lot of the regulators saying, how does this not harm competition, harm availability of titles? And I think for Take-Two Interactive, a lot of the other tertiary names, they perhaps were winners as a result of what was coming to fruition or coming about as a result of a lot of regulators looking into that deal and saying, okay, now for the entire console space, we need to look across and see and make sure that this is one where consumers can have access to these titles regardless of the console that they're on as well.
Yeah, certainly. Again, Take-Two shares moving to the upside here this morning in the opening trading action. All right, well, keep it right here on Yahoo Finance. We've got all of your market action ahead. We'll be right back. China doubling down on economic recovery, but perhaps not the type investors were looking for. President Xi Jinping and other leaders pledged to focus on industrial policy come the new year. There had been hopes of a renewed focus on boosting domestic demand, while several China-based stocks leading the sell-off in Asia today, including developers, Longfor Group, and China's overseas land and investment. For more on what to expect in 2024, we're joined by Leland Miller. He's China Beige Book co-founder and CEO. Leland, it's great to see you here. So it looks like at least China, Xi Jinping, confident in the recovery, what that looks like heading into 2024. Investors, though, did not get the message, did not get the headlines that they were hoping to get here from the government. How do you see this initiative here shaping, or lack thereof, China's recovery as we look ahead to the new year?
Well, my big question is where these investors are getting their expectations from, because it's been very clear in 2021, then 2022, then 2023, and now going into 2024, that China's economic growth model has evolved, that there's a completely different stimulus playbook right now, and that Xi Jinping has no interest in using big bang stimulus in order to juice investor returns, in order to surge the stock market, in order to bring back artificially high levels of growth. And so the idea that every 3 months investors are disappointed by this sort of begs the question, why are they not smarter at this point? So I think the expectations right now should be very close to what they've been in the past, which is Beijing will do enough to make sure that the growth doesn't fall off too much. There will be a fiscal push in 2024, just like there was a monetary push in 2023, but the expectations should be tamed in terms of what they are going for. They want to make sure they stabilize the economy, not juice it.
Earlier in the show, our own Jared Blicker had mentioned that China has decoupled from the rest of the world, as he was taking a look at some of the movers earlier this morning here. Does this seem like a China that wants to recouple, that wants to reinitiate conversations and deal-making with the rest of the world from your perspective?
Well, the word decoupling is used in a lot of different ways. And if you look at broad decoupling, China hasn't decoupled from the rest of the world. Just look at the trade deficit, trade surplus that China runs with everyone, including the United States. Look, in specific sectors, there is decoupling. If you look at technology, there is an effort right now to decouple, the U.S. and Chinese economies, for instance. But, decoupling is overused. It's still two very interwoven economies. The problem is that China keeps pushing forth domestic policies that make foreign investors squeamish. They don't want to go to China and be arrested. They don't want to have problems with their, with where they store their data. They don't want to have problems, with political crackdowns and other things. So the domestic environment for investing is not very good right now, and so Xi Jinping is having a hard time bringing in more investment.
Yeah, Leland, to that point, we had some headlines here this week that the U.S. is in talks with NVIDIA about allowing some sales of some of their AI chips to China. In terms of the trade war that's been going on, the chip war that's been going on between the U.S. and China, has that at all been effective in terms of your checks and what you're seeing on the ground in China?
No, not at all. It's not a serious, it's a pillow fight, not a chip war. I mean, if you look at what happens right now, all the chip makers basically live at the White House pushing for the regulations to be eased and eased and eased. The reality is that there is not broad ban on, sending advanced technology to China. The headlines say there is, but you don't have broad prohibitions for the most part on sending this technology. What you have is a licensing regime. The Department of Commerce evaluates those licenses behind closed doors and overwhelmingly approves these licenses. These are for foreign firms. These are for Chinese firms. These are for U.S. and foreign firms selling to the Chinese market. Most of this continues to go on. So there is not this wall that being set up, and in which case, U.S. technology and Western technology is not flowing to China. There are Swiss cheese holes in it, and right now, chip makers are driving cars through them.
Leland, administration over administration, there's still continued to be this tough on China type of mindset that has essentially been passed on or tried to be shown to the American people. But at the end of the day as well, if we were to see, and we're seemingly going to get in 2024 general election, a rematch of President Trump versus former President, or President Biden versus former President Trump, at the end of the day, would a Trump presidency then have us reverting to even tougher kind of relationships with China and some of the other counterparts?
Well, I think in some ways, obviously, President Trump was much more focused on trade. It's true that President Biden mostly inherited what Trump put forward, but I think you'd see much more, and you will see as the campaigns ramp up, much more talk of trade issues and tariffs. The issue here is that there's so much focus on the trade aspects of the relationship and so little focus on other aspects, whether it's export controls, whether it's investment flows, from the United States into China. The risk is that the trade issue eclipses everything else, and that's all we talk about, instead of really walking through the issues one by one and establishing a priority list for getting the relationship right.
Leland, do you have any hope that the relationship is going to improve? And I guess when you take a look at what that relationship could look like in a longer term view, 5-10 years down the road, obviously very far out in the future, but how do you see the policies of the last several months kind of shaping that relationship going forward?
I think that we're in a position in which the relationship's going to continue to deteriorate. That doesn't mean it needs to crater. If U.S. policymakers are smart, they will adopt a priority list of things that are really important for national security purposes to get right with China. And we are not getting those things right now. If you get a priority list, then that means you don't have to throw every single policy against the wall like a bowl of spaghetti and try to hit China on everything at all times. What you want to have is smart policy that's focused on national security needs, and then you can have a reasonable commercial relationship with the country beyond that. But what really needs to happen right now is policymakers need to get their ducks in order and get a priority list of what needs to happen over the next year or two or three. And I think that would do a lot to settle the relationship and make it a smarter one.
Social media in the form of TikTok, smartphones, generative AI chips. What is the next kind of product shoe to drop here in its U.S.-China kind of tit-for-tat relationship battle?
I'm not confident anything's going to happen in 2024. The Biden administration seems to not want to push anything. Congress is, toying with stuff behind the scenes, but you saw every single China-related provision in the NDAA fail earlier this month. So it's not clear at all there's another shoe to drop anytime soon. I think that they will be looking closer in the new year at outbound investment because, you originally had a conversation in which, there was going to be a regime, sort of a reverse CFIUS. That got narrowed down. What's on the books right now is completely useless. So I think that there's a look again at how to do that right. But 2024, it's going to be a lot of loud talk. It's not at all clear there's going to be a lot of action.
All right, Leland Miller, always great to get your insight here. Thanks so much for taking the time to join us. China-based co-founder and CEO. Thanks, Leland. All right, U.S. steel shares rising this morning following reports from CNBC that the steelmaker has received several bids over $40 a share for the company. Now, the report saying that Cleveland-Cliffs is one of those bids that would be above its August bid of $35 a share. Now, sources for the report say that the board is set to meet later today. So this is all according to a CNBC report saying that U.S. Steel has received multiple bids for the steelmaker in excess of $40 a share. We've been talking a lot about Cleveland-Cliffs over the last several months. They really are the most maybe public face or public bidder here for the company over the last several months. Now, this new offer that CNBC is reporting is substantially higher than what was initially offered back in August. We have seen a number of companies potentially interested here in U.S. Steel. U.S. Steel in the past has said that they are open to exploring all strategic options. So again, this report here boosting shares up just about 3%.
Yeah, Cleveland-Cliffs saying in interviews over the summer, we've been talking about this now and the potential for this going through, what was offered. Cleveland-Cliffs from their perspective and their CEO, president and CEO, Lourenco Goncalves has said in the past that the government should not only be approving, but enthusiastically supporting this deal. And they're finally going to have, after a few decades, a steelmaker that is among the top 10 in the world. Him saying that in interviews in the past with CNBC, and now moving forward with even more of kind of as you're seeing more offers now come into the fray, it's a larger question of how many other players are now getting into the mix here as well. Also, JP Morgan is out with its call for the internet sector in 2024, saying it's keeping Amazon as the one top large cap pick for the upcoming year, along with a slew of other big names. And the reason, according to JP Morgan data, the internet sector has rebounded from its 2022 lows and significantly outperformed the market in 2023, with its coverage universe up 35% year to date. There you're taking a look at some of their key picks here. And we mentioned Amazon, one of the big themes that they've kind of pointed out in their internet themes here. More stable, normalized growth, margin gains, more mixed after some of the cost reduction efforts that have come forward over the course of this year. And then public cloud shifting from optimizations to reacceleration. Oh yeah, you couldn't go without mentioning generative AI. Year 2 is what they're kind of just summarizing it at. They've got high expectations, but still a lot to prove here.
They do, and also following in that investment criteria is just the fact that they still believe that these companies are at reasonable valuations. They prefer solid growth, proven profitability, a theme that we've been talking about with a number of strategists that have joined us here at Yahoo Finance over the last several weeks as we look ahead to some of these top picks for 2024. We hit Amazon. What also stuck out to me is what they had to say about Google, that is a new top pick for the company. They're basing it on improving ad growth, is something that we have been closely tracking here. So they see that trend continuing here as you look ahead to 2024. Also, some of those larger margins, generative AI, that gap that they're seeing, the tightening of that gap is what they are expecting into 2024, and that positions Google well. And then Uber was an interesting pick to me, just in terms of the fact that we are seeing some pressure on some of these consumer-facing names as consumers do pull back on spending. But JP Morgan making the case here, at least, that Uber remains a top pick because of its strength and profit focus. And they do see some of that momentum. They expect mobility and delivery demand to remain healthy despite some of these macro headwinds. And you can see year-to-date Uber has shot right up just about 150%, far outperforming their competitor Lyft. Obviously, very much, at least the street consensus is much better positioned given their diversified business when you compare it to a name like Lyft.
Like, my goodness, you're looking at a PE ratio that's double essentially what NVIDIA. And the year that has been for NVIDIA is looking like over at Uber there. So PE ratio that we were seeing of about 120 a moment ago here as I was checking things very briefly. But I think more interestingly, the mobility growth normalizing post-recovery. That was an interesting call out for Uber in this note.
It was. So Uber, Amazon, and Google, the top picks here for large cap companies from JP Morgan heading into next year for tech. All right, we'll keep it right here on Yahoo Finance. We've got all of your market action ahead. Stay tuned.
Good morning, everyone. I'm Brad Smith alongside Shauna Smith here live in New York City. We are about 30 minutes into the trading day. You're watching Yahoo Finance Live. Let's take a look at how things are shaping up right now. Stocks flat ahead of the Federal Reserve's rate decision. The central bank widely expected to hold rates steady this afternoon in its final policy meeting this year.
Taking a look at some individual names, shares of luxury car maker Ferrari lowered this morning. BNP Paribas downgrading the Italian stallion to neutral from its outperform rating. The company seeing limited earnings upgrade potential in the coming months. You're looking at losses of just over 1%.
All right. We're also watching shares of Southwest Airlines, the airline carrier lifting its Q4 revenue outlook, although the carrier is expecting higher jet fuel costs in the coming quarter. Southwest is still seeing higher travel demand and ticket prices over the holidays.
And Johnson & Johnson falling after Wells Fargo downgraded the stock from overweight to equal weight. Now the investment firm believes J&J's EPS growth will be fairly muted in the coming quarters and believes that Johnson & Johnson may need more M&A to sustain its higher medtech sales outlook. Well, stocks flat as investors brace for the Federal Reserve's last interest rate decision of the year. Markets are largely betting that the next time the Fed does take action on rates, it will likely be a cut. But new research out showing that the Fed's pause period might actually be better for stocks. Yahoo Finance markets reporter Josh Schaefer is here to break it all down for us. What do you have, Josh?
Yeah, Shauna. So a big story this year has been a lot of money coming into money market accounts as interest rates have been higher. And essentially, when should investors get out of those money market accounts? 5% on cash is great, but in the long run, normally being in the market does better. Should it come when we're in the pause period, when we're cutting? So BlackRock with this nice graph here that shows us the 6 months before the last hike, which have already passed, obviously, or at least most people think they've already passed, or what happens when we're in a pause period, which most people think is right now. A lot of people thinking July was the last hike, which would mean the pause technically started in July. That's how BlackRock did this analysis. And then you look at the 6 months after the first cut. So a lot of people obviously thinking a rate cut would be good for stocks, specifically stocks maybe that have been interest rate sensitive. But this research sort of telling us a lot of the rate cut positivity actually gets priced in during the pause period, which might be what we're in now. So BlackRock sort of saying it might be time to get out of some of that cash. And when we take a look at another graph, this is just stocks versus cash returns over the last couple economic cycles. So each new line here starts when we had a recession, and you can see 5 out of the last 8 economic cycles, stocks significantly outperforming cash and the interest that we get on cash. A final thing I want to point to here, when we take a look just overall what the S&P 500 has done since that pause started, you can see we've taken quite a big leg up here, specifically since September and October when we headed lower after that last Fed meeting. So we've sort of already seen this pause period trade playing out. Now the question for investors will be, do we see more of it if the Fed does stay on pause over the next couple months here?
All right, we're going to be watching closely for anything Fed Chair Jay Powell and everything Jay Powell says later on today. Josh, thanks so much for the breakdown. Appreciate it. Well, is the economy on track for a soft landing? That's a big question. U.S. Treasury Secretary Janet Yellen seems to think so. She said at the Wall Street Journal's CEO Council Summit that the economy is currently on path with inflation falling. She added that the job market remains strong and there isn't, quote, any good reason to think that the last mile is going to be especially difficult. But our next guest does not agree. Let's bring in Cindy Beaulieu, who is the Conning CIO of North America. Great to have you here with us this morning. First and foremost, soft landing, your own projection, and are you more in the camp of Treasury Secretary Yellen, or is there something else that you believe is brewing?
That's a great question, Brad. Thank you. It's great to be here. So as we talk about soft landing, we have not been a buyer of that possibility really since the beginning. We didn't see how the Fed was going to navigate that when you think about how dislocated the economy was as a result of COVID. And to actually bring us into a soft landing through all of that would be really quite miraculous. And didn't seem to be in the cards. We felt a little bit more confident about that idea as we've moved through the back half of this year, and we've seen the way the economy is reacting to some of what the Fed has done to this point, or all of what the Fed has done to this point, but the full reaction hasn't really been felt yet. We've seen the rolling recession, and we do believe in it, and so housing had it, manufacturing has had it, and now we're heading for the consumer. And we think that the consumer does really pull back in these next several months. That puts us at the point of a mild, modest recession in the late first quarter into the second quarter of next year. And that is why we don't see the possibility for a soft landing. The consumer has been incredibly resilient, but we're starting to see enough cracks to suggest that maybe the consumer is finally wearing down.
So, Cindy, if investors do agree with you, they're trying to figure out how to best position their portfolio, maybe prepare their portfolio for a recession. What are some of the adjustments that investors should be making right now?
Sure, that's a great question, Shauna. So, as we look at where markets sit today, we think that they are way ahead of where they should be. Rates have come down dramatically since the November Fed meeting, and that's really been on the back of economic data that market participants feel is lining up to enough softness that the Fed can actually pivot, and maybe even pivot at the end of the first quarter or early second quarter of next year. We don't see that. So we would suggest that you certainly can be in bonds, and that buying some duration in bonds makes some sense, but maybe be a little bit patient with it, because if we're right about how we expect Jay Powell to take the podium today, then we don't think the current level of a 10-year Treasury is appropriate, and we may see a little bit of a rate sell-off here if he's hawkish enough. So we think that there's room for bonds and portfolios for sure. We like less cyclical names, certainly as we try to work our way through this last part of the recession. And we like, generally speaking, though, investment-grade corporates, high-quality corporates. We also like a lot of the structured parts of the market. And I think that that's an area where it's been a little bit left behind through all of this, because people have feared if we get a significant recession, they think back to the great financial crisis, and they don't want to own mortgages. The mortgages we see today are not the mortgages of 2008. And so there's certainly room to have a mortgage allocation in portfolios, and we think it can be a quite attractive income stream.
Cindy, you mentioned what the markets are going to be listening for when Fed Chair Jay Powell takes the podium later on today. Jack Manley from JP Morgan earlier in the show gave us the kind of sobering cold water reminder that it's not the Fed's responsibility to tell markets what the markets want to hear. They have their own dual mandate, and they move forward with that eye on inflation and full employment. All that considered, what will you be listening for that can ultimately kind of signal one way or another that we could potentially get the rate cuts next year that the market is looking for, hoping for, and kind of banking some of their own portfolio strategies around?
Sure. I mean, we're basically looking at three key factors today at 2 o'clock. One is going to be the positioning of the dot plots. That's going to be incredibly critical to determine just how much of the rate cuts that market participants have built in, 125 to 150 basis points. Does the Fed really believe that they can execute anything close to that? And we think the market will be disappointed. The next thing we'll be looking at is the SEPs. The Fed backed out the recession call in June with the SEPs and maintained a pretty resilient looking economy with the September SEPs. So come December, in this next round, are they going to show, what level of economic growth do they expect in 2024? And is it going to signal that that soft landing maybe isn't a possibility? But also importantly, inflation. Right now, their core PCE target for 2024 is 2.6%. That's not 2%. And this market has been incredibly euphoric about the idea that we're going to have this immaculate disinflation just continue unchecked. And we don't see that. There are sticky elements of inflation that are going to make this more difficult for the Fed to continue for the Fed to bring rates down anytime soon. So we think between what you're seeing in shelter inflation and what you're seeing in services inflation, the Fed has to hold the course for longer. 25 or 50 basis points of rate cuts near the end of next year, that's certainly reasonable. But to stay out of the election cycle while inflation stays above their goal of 2%, we think that that's a reasonable way to think about things. And the last thing is this hawkish tone. we expect him to come out of the gates as hawkish as he possibly can be. And I think one of the things he could use to maybe get markets to understand what the Fed is thinking is to talk about the fact that maybe the neutral rate isn't what everybody thinks it is today. And maybe it does, in fact, have to be a little bit higher. And if they start to talk about that, that then starts to set the bar for where rates have to go from here. And I think that's how you get the disappointment and you see all parts of the curve shift higher.
Well, Cindy, what are your thoughts just on the neutral rate and where you think maybe it should be at this point?
So we do think it should be higher. We think that the Fed is going to have a very difficult time getting back to 2% for really quite some distance in the future. As we think about the things that have happened to the global economy over time, there are things that are just different now. Deglobalization is definitely a factor. The way we are spending money in this country on the fiscal side is also a factor. And when you think about the shift towards greener and cleaner energies, those are expensive and those are inflationary. So we don't expect that fiscal spend to go the other way anytime soon. And the other part of it is our aging population in this country. It's really a challenge. And so we have more and more people that are reliant on the government for support. That means more spending. So we see a path for inflation to maybe get back to about 2.5%, but it's really going to be tough to bring it back to 2%. And we also believe that at some point, the next that is, how do they start to think about moving that target a little bit higher as well?
Cindy Beaulieu, always great to get your perspective. Thanks so much for joining us here this morning. Conning, a CIO of North America. Thanks.
Great. Thank you.
Keep right here on Yahoo Finance. We've got all your market action ahead. Stay tuned.
One for the record books. Several names on the S&P 500 hitting all-time highs this week. Retail, home builders, the market rally has broadened from the names in big tech. With more on this and the biggest winners, we've got Yahoo Finance's Jared Blicker. Hey, Jared.
Thank you, Brad. Let's start with the Dow, which is not at a record high, by the way, but almost hit one yesterday. It was the third best day ever, third highest day ever. This is what the Dow is down over the last 3 months. You can see from the end of October, really accelerated. By the way, another stat I just read was that between this meeting and the last Fed meeting, we have the best performance in the S&P 500, almost 10% since 2009, those intermeeting Fed meetings times. Pretty, usually about 6 weeks between them. And I just throw that out there to show how blistering this rally has been. Now, here's a 3-year look at the Dow, and you can see just barely testing these levels that we've seen here. But I want to move on. As you indicated, Brad, this rally has really broadened out. We're seeing home builders, that's up 14% over the last month. And let me show a year-to-date chart just to show you how this sector has evolved. A lot of people might think with mortgage rates high and with so many problems in the housing market, guess what? Home builders are doing quite all right, up 46% after this dip here. And like a lot of other stocks, that game of catch-up played in November. Then you're taking a look at European financials. Let's take a longer-term max look at this. This is one of the most dead money. Take your money and leave it there, and it will do nothing sectors I've seen in a long time. This goes back to, well, what is that, over 10 years, and just a lot of sideways chop. Nevertheless, it's picked up recently, and that just shows you when Europe picks up, that is astoundingly bullish here, generally for the rest of the world. Here are chip stocks, and you can see those really didn't even lose much ground when we were correcting here, kind of going sideways in this particular market for a few months at record highs right now. I'm going to skip through these other ones. PAVE is infrastructure. KIE, K-I-E, that's insurance. And we went over, let's check out this. ITA is defense stocks. Now, aerospace and defense, not defensive. And this is just a blistering rally right here. You can see the 2-month performance up 14%. And it's not just sectors, and we have a number of those here. We do have, guess what? All these individual names, these are at record highs, not necessarily today, but yesterday, the day before, they are near there. And a lot of representation in the chip stocks, which we just went over. Broadcom, that's up 16% over the trailing month, but also seeing financials pick up. Visa, arguably also tech, that's up 6%. Costco up 9%, so a consumer staple name right there. T-Mobile up 8% over the last month. That is a telecom name. And then in travel, we are also seeing some of the hotels do quite well, along with Booking. Booking up 70%. Now, ServiceNow up 83%, and the list goes on. So we take a look at the year-to-date performance here. I don't think anybody would have predicted this coming into this year after the disaster we had last year, not only in stocks, but also bonds. But pretty interesting to see how all of this has occurred really within the last 6 weeks. We've just seen this incredible game of catch up, and Wall Street, well, they've pretty much won the game here. They had to catch up to their benchmark, and if they used a lot of leverage, they might be almost there. We have the rest of the month in December, and just tracking what happens year to date or in the month of December, we generally see the gains at the end of the month. So we could be looking at some more gains towards the end of the year. The low VIX is also in play, down to a 12 handle. All of this is supporting the bullish case in equities, and we'll have to look and see if the Fed changes the narrative today.
Hopefully it doesn't. Hopefully we're looking at more gains here between now and year end. All right, Jared, thank you. Let's talk a little bit more about what's ahead for next year, because tech stocks were certainly the star of the show for most of 2023. The so-called Magnificent Seven, fueled by AI enthusiasm, driving the market higher over the course of the year. But possible headwinds could be ahead. There's antitrust lawsuits. We got the ruling yesterday, the latest App Store crackdown against Google, regulators in Europe scrutinizing the industry's concentration of power, and a fear that tech valuations ballooned by AI enthusiasm could come crashing back down. With more on what to expect in tech in 2024, I want to bring in Bob O'Donnell, tech analysis research president and chief analyst. Bob, it's great to have you here in studio. So that was a long intro just in terms of some of the biggest headlines that we've seen play out in tech in 2023. Looking ahead to 2024, I think a lot of investors are first focused on that AI enthusiasm. Yep. What do you think that looks like next year?
Well, look, I mean, you could argue that we're overhyped now, and yet real people are just starting to get this stuff in their hands. You think about things like Microsoft's 365, Google's Workspace, Now what's happening is really it's been a tech industry discussion and a little bit of a financial industry discussion, but those tools are starting to get into the hands of people, and really, well, we won't see that till 2024. And I think a lot of people are just going to have their minds blown by this stuff because it really is powerful stuff. So I do think we're going to see continued enthusiasm. I think we're going to see some of the bigger players. I think we're going to see Microsoft. We're going to see Google. We're going to see Meta, who's becoming increasingly important into AI, and some of these other big companies really start to make a stand. Then I think we'll also start to see some of the little companies, Amazon making a bigger purchase in Anthropic. They just did that. We could see more of that, right? Microsoft doing more with OpenAI. There's a lot of those plays that I think we could see next year because there's huge interest in and a recognition that there's only a few companies in the world can really build these enormous models. And you're going to have to be aligned with one of those. Companies will end up using a couple of them. I do think it's going to get a little messy in that regard next year. But fundamentally, you have to have that basis, and then from there you build. So that's what I'm going to be looking at. That's what I'm, from an industry perspective, trying to say, okay, how does this move forward? How do we think about these combinations? And then, again, in the real world, how do companies start to say, okay, I'm going to use Microsoft for this. I'm going to use Amazon for this. I'm going to use Google for this. I think that could be the reality next year.
What type of acceleration, do we see in 2024 or foresee from your perspective with regard to monetization of a lot of this? Because, it's still, if you think about ChatGPT as the generative AI kitchen table talking point for so many households out there, it's still a larger question of, all right, well, how much would we really feel comfortable paying for it? And then you can scale that all the way up to the organizational side where they've said, this is going to help out with productivity and trying to figure out how much they pay for generative AI.
Yeah, well, and look, Microsoft has said it's $30 a head for Office.
Right.
Google's done the same thing, right? So, and it's going to be those kinds of services. Again, none of that money is kicked in yet at all, right? Right now, you've got a bunch of companies who are beta testing it. That's why I'm saying in 2024, some of the reality of this kicks in because average companies and average people and everybody all of a sudden starts getting access to this. Now, having said that, I have heard a little bit of pushback from some companies like, hey, $30 a head times all my people, that's a lot of money, right? And so there is a little bit of a concern of will there be some pushback? What's that going to do to pricing? The truth of the matter is nobody really knows how to go to market just yet with this because of exactly what you're saying, Brad. Yes, this is really cool stuff, but how do I measure that productivity gain? It's not super clear, and so we're going to see a lot of experimentation on pricing, on go-to-market, on marketing, on packaging of all this stuff as well.
Bob, we also raised some issues there in the intro to your segment just about antitrust regulation, what that could look like, how big of a headwind that could be for tech next year. Also, valuation, still some concern following the massive runoff that we've seen in a handful of names. What would you view as a top risk for tech heading into the new year?
Well, I do think the antitrust things are potentially problematic, right? You can't ignore the fact. What's crazy is a lot of the things are backwards looking. And for example, there's this discussion of, obviously there was the Google Epic story and what's going to happen there and, who benefits from that? Well, mostly it's game companies, right? It's the gaming companies that may benefit from that. But, there's some discussion about Google's monopoly in search. Well, ironically, when we start to look at generative AI, people are kind of replacing traditional search with generative AI tools. So that's going to dramatically change that perspective. That's why it's so critical for Google to get in there, but it opens up opportunities for other people as well. So, but I do think, to your point, Shauna, that, these kinds of regulatory issues could absolutely come back and bite some of the big companies because there is a sense, that's driven all this, that these companies have so much influence and control over our lives in ways that we don't even really think about, that perhaps there is a need to kind of put some of this stuff in check. So we'll see what happens, and there's always unintentional consequences sometimes from these moves, and that's really what's going to be interesting to look for in 24.
You've got applications that sit on top of models, models that sit on top of chips. Chips have been the big winner by and large over the course of 2023. What does that signal for 2024 and some of the companies then that could be the biggest winners if there's more of a transition into, okay, now we focus on the actual application that people can have in their hands?
Yeah, no, it's a great question. So obviously NVIDIA continues to lead on the training side. AMD had a big event last week where they talked about what they're doing. I think there's a lot of opportunity. Look, people, as much as they love NVIDIA, they want a competitor, right? They really want people. It's like, hey, we can't be completely dominated. AMD is the obvious choice there. The other interesting thing, later this week, I'm here in New York for an Intel event where they're going to talk about some of their new AI chips. Right. And what we're going to see is AI running on our PCs and other devices. And that's going to start to change the game. Now, it's not going to happen overnight, let's be clear. But there are some interesting opportunities when we look at an Intel. We look at a Qualcomm who's going to have some big AI. They already announced it. It's not going to ship till 2024. AMD as well. So all of a sudden, and of course, NVIDIA. So you've got all of these kinds of companies. And you've got smaller players who's starting to think about doing things on, they're talking about AI on the edge. What sorts of applications they can leverage intelligence for other kinds of applications, factory automation, all sorts of other areas. Not as sexy and not as well known and smaller, but in some become interesting. So a lot of interesting players on the chip front to watch, I think, over the next year. Again, I don't think there's going to be somebody that comes out of the blue. This is not a business that somebody can all of a sudden come out of the blue. You kind of know who it's going to be, right? Yeah. It's just a question of degree.
Yeah, absolutely. And how much money they're deploying towards a lot of these solutions too. That Intel AI Everywhere event going to be taking place tomorrow, I believe. So we'll see how INTC ticker symbol moves around on that day. Bob, thanks so much for taking the time here with us. Guys. Bob O'Donnell, Tech Analysis Research LLC President and Chief Analyst. Coming up, the countdown continues. We're breaking down the biggest stories of 2023. Number 6 is up next.
We are counting down the top 10 stories of the year here at Yahoo Finance, and coming in at number 6 is retail theft. Target, Walmart, Walgreens, Home Depot, all calling out theft as a real threat to their business.
It's a $100 billion problem for our industry as a whole, so it's a big problem.
Shrink, though, has been one of the common lines and threads that we've been able to draw, unfortunately, through many of these retail earnings this season.
They're in a position now where these type of flash robberies, these smash and grabs, or they've been called mobberies, are very lucrative and very successful for them.
Well, retailers sounded the alarm in 2023 as retail theft climbed in the headlines, with giants like Walmart, Target, Home Depot, Nordstrom, and others all mentioning it as an issue. But how much of it is actual theft? Brooke DePalma joins us now with more on that. Hey, Brooke.
Good morning, Shauna. Well, inventory shrinkage is really that overarching term that includes the loss of items to retail theft, organized crime, internal theft like employees stealing, errors, among other factors. And while retail theft certainly garnered attention across Main Street and Wall Street in 2023, we actually won't know the true financial impact until next year, once all retailers' fiscal years have ended. But what we do know now is that in fiscal year 2022, there already was a 1.6% increase, accounting for $112.1 billion in losses. Now, previously, it was believed that the majority of that theft was from organized retail groups. What we now know is that the majority of shrink is from both organized retail crime and employee theft. That's followed by errors that make up about 27% of total shrink and unknown or other reasons after that. But retailers have gotten so many questions about what exactly this means for the company's bottom line. Target CEO said earlier this year there was a 120% increase in the first 5 months of 2023 involving violence and threats. And that ultimately led to the retail giant closing 9 stores in October, blaming theft and organized retail crime for contributing to an unsustainable business performance at those stores. Now, Target expects inventory shrinkage, but mostly theft, to cut profits by $500 million in total this year. Meanwhile, at stores that remain open, that tend to be hit by theft, Target installed things like locked cases, additional security, and is even training store leaders and employees to combat this. Now, when I went to Walmart's annual meeting back in May, CEO Doug McMillon said that at the time, the company really does prefer to never lock anything up, since it really does interfere with customers' experience. But U.S. CEO John Furner said in a call that shrink has increased a bit both this year and last year, but it remains uneven across the U.S. Now, Nordstrom's CEO said on an earnings call that loss to theft is still at a historical high, calling it unacceptable. And at the end of the day, many experts believe that the only way to really solve this issue is for retailers, third-party sellers, those who may have stolen goods, then putting them on their platforms. In addition to law enforcement, legislators, well, many believe that they all need to work together. And that'll be something that we'll certainly be looking out for in 2024. Many hoping it happens, but really unclear if it will.
All right, excellent breakdown there. Brooke, stay with us. We've got much more on this topic, as retail theft is just one of the headwinds that retailers faced in 2023. They were also hit with sticky inflation and a softening consumer. As we tracked these companies throughout the year, time and time again, a few stood out on top as consumers looked to value when spending. Here to analyze the year that was and give his outlook for 2024 is Oliver Chen, TD Cowen Senior Research Analyst. Plus, we still have our very own Brooke DePalma with us. Oliver, great to see you. When you look back at 2023, how good of a year was it for retail, and how much did theft really factor into the big picture?
Yeah, Brad, it's been mixed in terms of the consumer. On the one hand, inflation has been a headwind for sure, and consumer discretionary trends have been more negative as inflation has taken away dollars. That being said, there's still a lot of spending power. Unemployment is low at below 4%, $700 billion of savings on the sideline. And we had a better than feared Black Friday. People are going back to stores. Store traffic is slightly positive. But there aren't all winners. There are winners and losers. Aspirational luxury, more entry price luxury has been a tougher place. Discretionary has been a tougher place. And people have been spending on essentials such as grocery and beauty. At Walmart, we like the grocery exposure, which is about 60% of revenues. We also like that what we call the new nexus, meaning Walmart using artificial intelligence, Walmart using marketplace models, and Walmart embracing digital advertising. So those three factors, digital advertising, marketplaces, artificial intelligence, they are key to long-term better operating margins. AI will play a big role during purchase, before purchase, after purchase. Specifically, we're out with a book today. We think AI will impact merchandising, labor, and inventory. And this could improve return on invested capital as well as improve margins as well.
And Oliver, just to bring it back to retail theft, like we just discussed, yesterday there was a hearing on the Hill, and a Home Depot executive said that passing the Combating Organized Retail Crime Act of 2023 would be a critical step to solve this issue. Do you think this sort of legislation would help retail theft?
Yeah, Sean, I think people do need to collaborate, and over a longer time horizon, certainly. What we see happening is the rise of technology platforms that allow resale has been a factor in driving shrink. What retailers can do within their control in the near term, and they are doing, is people and fixtures, and there's been investments there. So it's something we're watching. Unfortunately, some of the higher value items such as personal care, fragrances, beauty, luxury, those have been items that have been more likely, to be stolen.
Oliver, from your purview, are there any companies that are addressing this better than others? We have heard a number of CEOs come out with statements, different actions that they plan to take in order to mitigate some of this risk. But who do you think, if anyone, has been most effective?
We've been pleased in terms of some of the initiatives Ulta has taken in terms of fixtures and labor. We also think Walmart has a really attractive perspective on labor and promotion and store management. As we think about artificial intelligence, which is a huge theme for us this year, AI will have lots of boring applications, such as fraud detection, inventory accuracy, computer vision, large language models. This can really help retailers understand, the right stuff, the right place at the right time, and also deter and manage theft as well. So those are things we're watching.
And throughout 2023, as you discussed earlier, Walmart continues to gain higher income shoppers. Do you think they'll continue to gain share in 2024?
Yeah, we're excited about that. Walmart is our top idea, and we're out with a note this week on that. And Walmart Plus, the membership program, which is over 24 million members, is a key positive. Getting higher income customers has happened in part because of initiatives like curbside pickup, where you don't really even have to go in the store. Also, Walmart's marketplace, it's a trusted marketplace with attractive everyday low prices. That's been a big factor too, as they've expanded that assortment. All these initiatives, everybody likes a bargain, and that will be attractive to wealthier customers too, as we see lots of pressure and people trading down. The other name we like is Costco. The Kirkland brand there is pretty legendary.
Everybody does like a good bargain, Oliver. Look, I try to negotiate everywhere. It could be at McDonald's, and I'm trying to get a better deal than they're offering. At the end of the day, when you think about the state of the consumer and where you believe the consumer will be in 2024, what's one word that you would use to describe him?
Optimistic, cautiously optimistic, but optimistic. I'm bullish, and I'm an enthusiast for shopping and what's happening. But the consumer, as you mentioned, Brad, will be very value-centric. So prices matter, and that will be a factor. As we look ahead, what's going to be exciting is beauty, wellness, thinking about those categories as health is a new wealth, and that's important to everybody too. So I would say optimistic, and I am encouraged by what we're seeing, but it's selective too. Keep in mind, the Walmart story is because it's a leading grocer, and we've seen inflation in grocery, which has benefited comp store sales. The other focus strategically that we should be focused on is the need for retailers to generate unit sales and also higher conversion rates. And traffic is going to be pretty sluggish. So there's really a mixed picture here. The consumer is undergoing a tug of war, meaning that the consumer is vacillating between what they need versus what they want. And there's also that will also be a big consideration where there's cross currents, and what we're seeing, consumer confidence has been fairly volatile as well.
All right, Oliver Chen, always great to get your insight here. TD Cowen, Senior Research Analyst. Our thanks to you, and of course our thanks to Brooke DePalma as well.
Happy holidays.
You too. All right, we'll keep right here on Yahoo Finance. We've got more of your market action ahead. Stay tuned. We'll be right back.
McDonald's opened its first new restaurant concept, Cosmix, last week. Reception is hot, but is it really a flop? That's the question right now, at least. According to a report from the Wall Street Journal, customers are experiencing waits of up to 3.5 hours, and some products end up being unavailable. For more on this, we've got Yahoo Finance reporter Brooke DePalma here. I can't imagine those fries are still warm after 3.5 hours.
Well, luckily, they actually don't even sell fries, so look at that.
Eggs on my face.
But this was formally introduced over the weekend, and it's gotten so much buzz on social media. People waiting up to 4 hours in line just to try out this new, smaller format, beverage-focused concept from McDonald's. It's originally or supposed to be open from 6 a.m. until 8 p.m., but they did have to cut off the line at 4 p.m. on Saturday after consumers were waiting roughly 4 hours. Now, they do have nearly 40 beverage options, bites like savory hash browns, as well as pretzel bites, shakes and cones, but some customers were met with those sundaes not working because the machine was down. And so lots of trial and error here, but it does tend to be slightly high calorie, high sugar, and the cost of it actually is a little bit less than Starbucks. According to William Blair analyst Sharon, she said that the likelihood of posing a material threat to both Dutch Bros and Starbucks is relatively muted. They said in terms of price point, it is a modest price discount of 7 to 8% that only equates to about a 35 cents less per an item than compared to that of Starbucks. Now, Starbucks largely known for those customizable drinks. Well, that probably won't be the case here at Cosmix. They do have a pretty core menu that they likely will stick to just because of the complexity involved. And then when you think of Dutch Bros, they do have a similar drive-through format, but with new incoming CEO at Dutch Bros, Christine Barone, she is president right now. I think they'll be highly focused on snacks coming in. That's what William Blair also weighed in on. That's something that they don't have a huge variety of right now. Cosmix coming in with a huge variety of snacks, and so that'll be something to watch out for in 2024. But important to note, this is only a test concept. They have 9 more locations opening up in Texas, where Dutch Bros just made a heavy investment with more 150 locations there. And so lots to look out for in this beverage small format concept as the big guys go against the biz guys here.
Yeah, certainly will be interesting to see how this spinoff develops going forward. All right, Brooke, thanks so much. Well, this year's holiday spending is expected to break records. The National Retail Federation expecting to see Americans spend around $960 billion this year. Some of that will be spent on third-party and resale sites to get some of this season's most coveted and exclusive items. That's where StockX comes in, a marketplace to buy and sell sneakers, apparel, and much more. Here to break it all down and what we've seen so far this year and what we can expect looking ahead to next year, we want to bring in Scott Cutler. He's the CEO of StockX. Scott, it's great to have you here in studio with us. Let's talk about what you're seeing this holiday season. What has demand been like?
You know, 2023 has been an interesting year for the consumer. On the one hand, super challenged, and I think that was maybe my perspective coming into the holiday. But what we've seen is actually a real surge of interest and volumes on our platform. As you said, we reflect current culture, we reflect a young demographic, and we've seen a couple of really big trends, which has been one, a value-conscious consumer. And so on our site, which has always been associated with premium product, we've seen 35% of our transactions coming from products below retail. And then we're really seeing a surge of new brands that are finding a resurgence and growth in this market. Brands like ASICS and New Balance, Fear of God, have really seen growth in this market. So maybe that's a shift in consumer preferences in current culture, but it's been exciting to see it in real time.
You mentioning a more value-conscious consumer kind of mirrors what we just heard from Oliver Chen over at TD Cowen in a more value-centric consumer that we're expecting going into 2024. How does that shift some of the most popular brands that you're expecting to see kind of move through listings and buyers and sellers continuing to flow in for certain names on the platform?
Well, our perspective is always, because the platform represents current market prices, the reflection of supply and demand. And I think that supply and demand is also a reflection of what's happening broadly out there in the economy. And so, what we've seen is certainly some brands and resale being that second sale. We've seen some brands see resale prices come down, but it's actually worked well for this time where the consumers can shop value. And so I think the interplay between that, as well as how much brands have been releasing out into the market, provides an opportunity for, again, our demographic being mostly a millennial, 65% millennial demographic, finding that opportunity to not only find heat, current culture, but also to be able to find value.
And Scott, one of the themes that we've been talking about with so many retailers this holiday season and really over the last several months has been promotional activity. What's needed in order to get the customers that you have to keep spending on your platform, keep seeing more of a return there? What are you seeing in terms of that promotional activity? Because I believe you also have something you're just rolling out here for Christmas, 12 days of giftmas.
Yes, yes. So as a platform, we don't set prices. We don't own inventory. And so as our platform, we don't have promotional activity. Most of our activity is actually just trying to drive interest of the brands and the trends that are hot to give consumers a taste of what is current and what might be that great gift of the season. And so I think when we look at what's happening in apparel as an example with the rise of new brands, the shift of preferences in sneakers, and then also seeing a couple breakout performers, for example, in electronics, to see the new Sony console be a hot seller is exciting for us to be able to, see in the market.
Yeah, absolutely. I mean, we're taking a look at some of the top holiday products here. I like many other people out there, I get so disgruntled and frustrated when I get, you weren't selected and your entry wasn't selected on Sneakers app and things like that. And then, I make my way over to StockX to see what the selling price, what the resale price is looking like. I can't even find my Grimace Uggs right now. So, all that kind of to the side for a hot second here. When you think about the demographic and the changing kind of profile of the customer that you're expecting to come into the platform, we're continuing to hear from these brands that they're selling into Gen Z, and that Gen Z is the next big wave of retail customers out there. How are you attracting them?
Well, Gen Z actually has an expectation that across any platform at any time, they can get exactly what they want. And that's very difficult, even though from brand perspective, they're trying to drive scarcity. From a consumer perspective, they want access. And the resale markets have been a place where access has always been the number one driver in terms of I can get exactly what I want. But I think when you see brands, you showed it there as an example, UGG or Crocs breaking through, leveraging a scarcity model and actually being something that's highly sought after, but you can't actually get from the brand or in retail locations. And so as a result, you're seeing a surge of demand in the resale market in places like StockX for those types of brands that are hitting a perfect note with that consumer.
And Scott, when it comes to some of these trends that you've seen play out this year, as you look ahead to 2024 and beyond, how is that shaping your strategy, your growth, and what you see StockX looking like in the years to come?
Well, it's been amazing just to see the growth of the platform. We crossed over this year over 50 million trades on the platform. We had 200 million visitors that came to the platform this year. It skews to that millennial, Gen Z, Gen Alpha customer. And so for us, it's really how do we meet that customer where they are? And so as a platform to be able to have that access around the world, global access to trends, but also be able to give you that opportunity to play in different price points. And then the other side that I find equally interesting is the economic opportunity that the platform allows, where a lot of kids are actually leveraging StockX as a place to fund a college education or to learn about the markets. And that's an exciting part of our platform that exposes that economic opportunity for the sell side of our market.
Scott, we got to let you go. I always ask you about IPO and when that might be happening. I'm not going to do that today. But I mean, looking out into next year and some of the uncertainty that CEOs have cited, how confident are you going into that type of environment?
I think CEOs today are probably, I wouldn't say totally confident, but getting more confident about maybe are we getting to the other side. I think the pressures that everybody has seen in terms of interest rates, inflation, macro weakness, I don't think they're behind us, but I think the runway in front of us is looking better than it had been maybe over the past. And so I'm optimistic that as we look at the later part of 24 and into 25, that the economy starts to shift in terms of certainly what we've experienced the last couple of years.
Scott, great to have you here in studio with us. Scott Cutler, CEO of StockX, joining us here on set. Just lastly, one more story we got to get your way. ByteDance may be scrapping its plans to create its new VR headset, Pico 5, according to a report from The Information. This comes after sales for Pico 4, the latest version of ByteDance's virtual reality headset, reportedly failed to meet sales expectations here. It's been big VR headset energy this year, whether it be Apple, whether it be Facebook or Meta platforms.
It has been, and I think this headline here with ByteDance kind of points to the issue that we have been talking about now for so long, what the demand is going to look like for these headsets, especially when you couple it with the price and what many of these cost, just trying to gain massive access in terms of widespread adoption. We have seen that a bit limited, especially when it comes to some of the offerings here from Apple. The fact that ByteDance is deciding to forgo the Pico 5, maybe don't look too much into that, given the fact that they have rolled out the Pico 4. They do have plans for what they're calling a bigger swan type project ahead next year, which is going to be released, we still think, in 2024. But questions just about how commercial, I guess, what that reception is going to look like and whether or not people are going to be willing to spend their money on it, especially given the environment that we've been talking about now.
I just looked up a VR headset on StockX, so I'm going to go check that out perhaps
There
later
we go.
on.
We should have asked Scott about it when we had the time.
Connection.
All right, well, that does it for us today. But keep right here on Yahoo Finance. Jared Blicker and Madison Mills have you for the next hour. We'll see you tomorrow.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Jared Blicker along with Madison Mills. Here's what we're watching today. The final Fed decision of 2023 looms as investors brace for impact. What this could signal for markets heading into the new year.
And a big media milestone, TikTok has become the first non-gaming app to cross $10 billion in consumer spending. How's it outshining the competition? We'll have that this hour.
Plus, streaming strategy. Netflix has released its most comprehensive engagement report to date. But what does this mean for the company's future content?
But first, let's take a look at some of the market's action that we're seeing here. A lot of green on your screen. We've got the Dow Jones a little bit in the green, kind of unchanged there, but more action in the S&P, up 0.2%, and the NASDAQ is up 0.3% here as we await that Fed meeting coming up later today. And just taking a look at what's leading these sectors, the only red that I'm seeing on my end here in the S&P is consumer discretionary and materials here. So those are the only two laggards. Utilities and real estate actually the biggest gainers when it comes to the S&P 500 movement that we're seeing here today. I also want to take a look at what specific members are leading here. We have Vertex Pharmaceuticals and Illumina leading. That leads to a little bit more of that commentary that we've had about the healthcare space potentially leading to more gains in 2024. Also seeing a couple of names here that were benefited by that outcome of the Alphabet Epic lawsuit out in San Francisco. We've got Take-Two and Match Group up today. Those are some of the winners from that if we do see App Store fees going down. And then, Jared, some of the laggards today, we've got Pfizer, Southwest, and Moderna. Also Paramount, all the biggest laggards today in the S&P 500.
Thank you, Maddie. We want to check on the Treasury market as well real quick. 10-year T-note yield, that is down 5 basis points to a nearly 3-month low right there. And a 30-year clocking in at 4.27%. That's down 0.3%, Maddie.
Well, the Fed's last decision of the year looming large as Chair Jay Powell is set to give the latest policy move at 2 p.m. Eastern today. Basically, no doubt here that the Fed is done raising rates, right? At least for now. But we've got some debate about how early and aggressively the central bank is going to cut in 2024. So here with what the Fed could signal for the new year, we've got our very own Fed reporter, Jennifer Schonberger. Jennifer, thanks so much for joining us. What is your impression here about what the dot plot could look like versus what the market is betting on for today?
Hey, Maddie, great to see you. So Wall Street pricing in 100 basis points of rate cuts over the next year, and I think that's misguided. My personal view is that the Fed is going to pencil in 125 basis point rate cut for next year. And the rationale behind that is that they had penciled in one more rate hike for this year. They're obviously not going to be doing that this afternoon. So if we take together what the dot plot said back in September, which was 50 basis points of rate cuts, I think they'll now say only one rate cut of 25 basis points. And that really signals higher for longer, right?
Yeah, Jennifer, I like your take on the cuts next year. I want to talk about inflation. We got some muted PPI numbers this morning. That's on the producer side. Consumer numbers yesterday largely in line and pretty flat, but still core services ex housing. That's something the Fed looks at it. When you take it on a 3-month annualized basis, that's still up over 5%, and so is rent of shelter. And so I'm just wondering how you think this plays into Jerome Powell's press conference later today.
Yeah, Jared, I think that he's going to say that this is still welcome progress, but it's not enough for the Fed to declare victory yet. He is going to want to strike a hawkish tone, which is why he's going to try to walk back Wall Street on these 100 basis points of rate cuts. The last thing that Chair Powell and the Fed want to do is to loosen financial conditions, which have already loosened, by the way, markedly. You just talked about the Treasury market. We were at 5% on the 10-year Treasury 3 months ago. We've now done a 180 turn back to where we were pre-September policy meeting. And so the Fed chair doesn't want to see all the hard work that the Fed has done so far deteriorate further, lest they see progress on inflation slow down.
All right, have to leave it there, but thank you for that, Jennifer Schonberger, and we're going to be talking with you throughout the day.
Thanks, Jared.
The soft landing debate continues, and all eyes will be on the Fed today as Chair Jay Powell set to speak following the FOMC's last meeting of the year. Investors are going to be tracking Powell's comments as the last piece of the soft landing puzzle before we head into 2024. Treasury Secretary Janet Yellen is a soft landing advocate, saying at the Wall Street Journal's CEO Council Summit that she believes we are on that path as the economy continues to grow. The labor market remains strong and also as inflation comes down. Now, our next guest, he says that the market's current confidence in a soft landing may be too high. Let's bring in now John McClain, Brandywine Global Portfolio Manager. John, thank you for joining us here today. Despite what Janet Yellen might be an advocate for, this soft landing, how realistic is this?
I think it's going to be really challenging, and I would agree with Jennifer in the last segment here. We're going to expect very hawkish rhetoric from Powell. Financial conditions have eased materially over the past month and a half here, and I think we're going to see the market actually shrug it off. So it's going to be challenging to navigate a soft landing. 2023 was actually fairly easy from the Fed's perspective because inflation did run rampant and was the sole focus for them. 2024 is going to have to be much more of a tightrope act. They're going to have to balance unemployment with inflation.
John, what sentence could Jay Powell say today to prevent the market from just slugging this meeting off?
Higher for longer.
Well, exactly. But I'm curious, too, in your perspective, is that going to be enough, right? If he indicates any sort of thinking about cutting rates, is higher for longer enough?
No, I don't think so. I think, look, animal spirits are running rampant, and Waller put gasoline on them as well. So, I think it's going to be very challenging for Powell today to be hawkish enough to pull back the animal spirits that have taken a hold of financial markets.
And where do you see these animal spirits going? I think you just said that you expect the markets to shrug off Powell's comments, but could you expand on, we've seen this incredible 6-week rally in just about everything, all the laggards, well, most of the laggards catching up or trying to catch up to the benchmarks this year. How does this complete the year, and how does the Fed influence that?
Well, this year looks a lot like 2019 and 2021 in terms of complete melt up, right? Everybody came into the year defensively positioned. It's a market that is the least exuberant that I've seen when we're near all-time highs in terms of the S&P 500 and a really strong performance across risk assets. So, I think the next couple of weeks, it's really FOMO, and it's really capital coming off the sidelines slowly into a reasonably illiquid marketplace across all risk assets at this point in time. So we're just going to see a melt up until the calendar resets and everybody starts back at zero.
What does that do to the bond market, given some of the tightness that we've been seeing?
Well, I think the bond market right now, we've said all of 2023 was about supply and demand, and supply is done for the year. And given the fact that we are continuing to see clients reallocate capital from equities into fixed income and taking cash off the sidelines and putting it into fixed income, we're going to continue to see spreads compress. We're going to continue to see financial conditions ease. We're going to start the year next year with a deep amount of new issue supply coming into the market at much more attractive rates for borrowers than they've seen over the past 3 to 6 months. So I think we see wide open capital markets for 90+% of corporations.
And just thinking about 2024, we got time for one more here. What do you see as some of the biggest headwinds to risk markets, to markets in general?
Well, I think risk markets have gotten far too ahead of themselves. So valuation is always the biggest issue. But I really think that markets are shrugging off the fact that inflation is dead. I don't believe that. I think we're going to see a strong fiscal impulse going into 2024. I think Janet Yellen's really been leading the markets, not Jay Powell. So I think that the degree of confidence that markets have that we've licked inflation and that the Fed's going to cut and cut aggressively in 2024 is mispriced.
Yeah, John, I know earlier we were talking a little bit about how there's a politicization that could happen with the Fed as well as we get closer to the election. So we'll have to bring you on as that November 2024 date gets closer to talk about that, John. Thank you so much for joining us. John McClain, Brandywine Global Portfolio Manager there for that conversation. So now let's take a look at today's trending ticker here because shares of Hertz being driven lower by a downgrade from Oppenheimer. The analysts cut the car rental company down to perform rating from outperform. They say that the next year is going to be a transition for the company. Among the headwinds that they know, they expect Hertz to face higher vehicle interest expenses and challenges to its electric vehicle initiative too, Jared. So you're really seeing the market not looking good for Hertz here, starting really in September as well, and then just kind of pattering out through the end of the year here.
You know, that's a key observation here because we were just talking about the incredible rally we've had over the last 6 weeks. Well, let's go to the interactive, and I'm going to plot Hertz versus Avis Budget, and you can see right around September we took a leg lower in Hertz, and if you take a look at the 2-year performance, you also see this breakdown here. Arguably, Avis Budget is a higher beta stock, and so the swings are greater, but really become disconnected. And if you take a look at the 5-year, well, this is a reminder that Hertz filed for bankruptcy, and they only emerged from it in 2021. So very different companies right there.
Yeah, and it's interesting, too, when you think about the inflation narrative. Are these rental car companies like Hertz going to be in a challenging position when it comes to pricing power? If we do continue to see disinflation, could that weigh on their ability to raise prices for consumers that are going to start to not necessarily want to put up with those prices, Jared?
Yeah, one more thing here. They're pausing their share buybacks in 2024, so that's another, I don't want to call it nail in the coffin. That's just another red strike against it.
Sure.
All right, coming up on the 12th day of Christmas, my true love gave to me more economic data. I love this Christmas. Our next guest shares her own spin on the 12 days of Christmas song as we look ahead to 2024 next.
TikTok is now the first non-gaming mobile app to generate $10 billion globally in consumer spending. That's according to a new report from Data.ai. So let's bring in Yahoo Finance's tech reporter Dan Halley to give us the details. Dan, I was just asking you if you've ever shopped on TikTok. I certainly have fallen victim to the TikTok shopping experience. To what extent is this becoming a broader spending issue?
It's, I deleted TikTok. Just so everyone knows, I have the strength, but I don't have the strength to delete Instagram. So someone's got my data. The thing that I think is worth pointing out here is the $10 billion amount isn't just the amount that it's brought in lifetime. It's specifically on what consumers have spent on this platform. So, that's why we're not seeing Facebook or Instagram on here as well. But the bigger deal is that it's not just what this app has done, it's that it's done it around other apps like games, right? So Candy Crush, I'm just gonna rag on my mom for being a Candy Crush fan. She's always crushing candy. Never wanted to watch me play Super Mario Brothers as a kid, but now she's just on Candy Crush on her iPad. That's done a lot of money, obviously, in sales. Clash of Clans has done a lot of money in terms of sales. And then others are starting to catch up, like Tinder and YouTube, as this report points out. But the way people are spending money on this is really interesting. It's going specifically to creators on TikTok. So people are giving these people money. It's similar to what happens on Twitch. You do, throw a couple of bucks someone's way, starts to add up, and then they end up being rich. And so they get these tokens. Those are converted into a kind of diamond through TikTok. TikTok gets half, the creator gets half, and everybody goes home happy, except for people's parents who are like, stop being on TikTok. But it really is just a wild change that we've seen where TikTok is now, yes, social media platform, but it's also generating incomes for these people, and it's getting tons of people to spend their cash. The other thing to point out is, it crossed that $10 billion barrier, but Data.ai is also saying it'll cross $15 billion next year. So, it's just, plateauing it, or not plateauing, it just keeps rolling and rolling. And I think one of the other things to look at is, the other apps in this list reached $1 billion a lot faster than TikTok. But the next billion and the next billion, or the next 1 to 5 billion, they were faster, and the next 5 to 10 billion, they blew them away. So the growth trajectory for TikTok is so much different than the games that are on here as well.
It's so interesting, Dan, that you note that it's about consumers paying creators. I would have thought that a larger part of this pie would have been revenue from the shopping experience within the app. So remains to be seen how much that's going to up the numbers that we're talking about, Dan. Thank you so much. That was really interesting. Really appreciate it. Speaking of spending, the bulls on Wall Street are back here. The stock market defying expectations this year. More strategists are putting many bear cases to rest now. So, who are these big bad bulls, and what are they seeing in this year ahead? Yahoo Finance's own Josh Schaefer here with the details. Josh, what do you got?
Yeah, Maddie, let's talk about the Bulls, right? Talking about the Bears can be a little sad, right? Let's talk about the big bad Bulls, because they're a little bit more excited this year. We know it's been 2024 outlook season on Wall Street, and we've been talking a lot about just S&P 500 projections. You can see on your screen there some pretty big calls. Fundstrat and Oppenheimer coming in at 5,200 from when they made those calls. That's about a 13% increase from where the S&P 500 was. But notably, too, one I want to highlight at the end of your screen there, Bank of America at 5,000. Last year, Bank of America saw stocks roughly flat. This year, they're projecting about a 10% increase, which sort of got me thinking, as we've been talking to a lot of these strategists, why more bullish this year? We're still talking about a recession. We're still talking about Fed uncertainty, and some of those tightening financial conditions could still come and grab corporates. We have the same issues that we had going into 23. But Savita Subramanian from Bank of America sort of laid out an interesting case. She said, we've had a year of surviving higher interest rates. She mentioned a company like Meta. Take a look at Meta's stock over the last year. It's done very well. They used that year of efficiency, and they actually created a better cost structure. Their costs were down 7% last quarter compared to the year prior. Margin went from 20% to 40% compared to the same quarter a year prior. So a company like Meta is a great example of companies sort of figuring out how to deal with this higher interest rate environment. And then the other thing that I talked to everyone about that was pretty funny was the recession, because a lot of these strategists on Wall Street that are pretty confident at this point just don't see the recession.
What recession? Too confident?
Maybe. Brian Belsky calling it a Chicken Little recession was probably my favorite. Brian Belsky over at BMO, pretty funny. But a lot of them essentially saying that they think the recession can be in some ways priced in at this point when you take a look at some of the stocks that have been beaten up over the last year.
Maybe we're back to the days when the recession is always 2 years away. We'll have to leave it there. Thank you for that, Josh Schaefer. New year, new outlook. As 2023 draws to a close, investors are looking forward to the new year despite talks of potential recession looming and a higher for longer interest rate regime. Our next guest is sharing her 2024 wish list with us and hopes investors have a prosperous year for stocks. She joins us now, Megan Horniman, Verdant's Capital Advisors Chief Investment Officer. And Megan, let's start with your take on the Fed. You hope investors see core inflation hit 2% next year. What are the chances you're going to see this happen and us?
Yeah, our wish list is exactly that for the next year. It's kind of a fun thing we do every year. It's a wish list. Some of these are highly unlikely. I think reaching that 2% inflation, yeah, we'd all love to see that. This would insinuate the perfect soft landing scenario that the Fed has been able to orchestrate. I find that highly unlikely, though. I think inflation is on a downward trajectory, but I think from here to get to 2% is going to be much more challenging for the Federal Reserve. I think that it's going to take some economic weakness in 2024 and even a recession in order for us to get there.
Megan, when this hit my inbox, I was so excited because you don't often get a 12 days of Christmas wish list amongst the Wall Street notes that we're reading through every day. Not that they're not all incredibly fascinating, but this was a much welcomed note. So thank you for this. I'm curious in terms of your outlook for the Fed. I know that you're wishing for no more rate hikes in 2024, but is there any chance that we are mispricing the potential for one more rate hike this year, or for the Fed to say, hey, 3% is not the new 2%.
Mm-hmm. Yeah, I do think that we are mispricing that. I think there's two things that are being mispriced. First of all, is the fact that they're going to be able to cut rates as aggressively as the markets are pricing in at this point in next year. I mean, there's forecasts between 100 and 150 basis points of rate cuts next year. We just don't see that likely. I think the Fed will give us that idea today when they speak. But I think the fact that they could be on hold for all of 2024, that could materialize. But I just don't think that the rate cuts are in the horizon that people are expecting.
We got to talk stocks now, specifically the Magnificent Seven. And I think next year you're hoping for maybe a more broad-based rally. We saw the concentration really heat up earlier in the year, and then we've had kind of a catch-up the last 6 weeks. But what's your take on what we can think about in terms of market breadth coming into the new year?
Yeah, so we had some fun with that. The seventh day of Christmas, we're hoping for it to spread beyond those 7 stocks. And still, I know there's been some movement and some bigger breadth in the market here most recently. But all that's being given the fact that the expectations for the Fed to cut. I think a lot of the rally in the Magnificent Seven and even this kind of melt up environment we've seen with this positive seasonal period is really that expectation that the Fed can cut rates. We're looking for a lot more volatility as we go into 2024. We'll be beyond this positive seasonal period. We'll also be in a situation where inflation, again, is stubborn. There are areas of inflation that we saw today, PPI come down at least on a flat basis month over month, but it's not really materializing in the CPI just yet. So we think that there's quite a bit of volatility. We think that once we get beyond the economic slowdown, when the Fed does start to look like they may cut rates, and I'm talking the possibility of very end of 2024 at the least, and I think more likely in 2025, that we can get a more breadth here in the market where we can see all market caps and even all styles start to participate in this rally.
All right, well, we also want to get your take on the housing market, specifically with the 30-year mortgage rate hitting a 23-year high this year. What are you hoping happens to that mortgage rate handle heading into 2024?
In my wish list, it would be great to see it come down to at least 6%. That would save an average home buyer about $300 a month. But I think that what we're going to see is the Fed's going to reiterate their higher for longer. With the Fed on hold and our deficit problem that we have with funding the long end of the curve, this is something I think we could see. Treasury disruptions, the auction disruptions go into 2024 and see some volatility in that long end. So it's a wishful thinking we can get down to that point. I don't know that it's likely in 2024. I think it's going to take rate cuts to see that, to see some real relief there in the mortgage rate. So I think the housing is going to still have a rocky year next year.
Megan, we're not going to get to all 12, but we have time for one more. Your choice. What can we expect for blank?
Yeah, the budget deficit, that's my big wish. And that's obviously not going to happen, but at 6% of GDP, I'd love to see that get back to, the third day of Christmas to that 3% of GDP level, which is what we're typically accustomed to. The deficit spending is out of control. We saw that net interest costs now are exceeding the money that we spent on the defense budget. This is problematic. And I know it's going to be tough in a presidential year to get anything to change in this, but I think that we all have to understand that austerity is most likely on the way sooner than later.
Yeah, Megan, getting anything to change in a presidential election year is tough, particularly with the deficit. So best of luck on that wish and all of the others. Megan Horniman, Verdant's Capital Advisors, Chief Investment Officer. We really appreciate it. Now, coming up, the outlook for retirement. It may be bleak for some investors, but we're going to talk about how ETFs could potentially help people play catch up. That's coming up next.
New year, new outlook. As 2023 draws to a close, brace yourself for a riveting financial look ahead to 2024. Here's what we'll be watching. The soft landing debate. Are we heading for a recession? The AI hype cycle. Is it still real? And the 2024 presidential race. President Biden and former President Trump seemingly set to square off yet again. We'll break down how this election could impact your long-term investments, so get ready to uncover the insights, predictions, and financial secrets that will set the stage for what's expected to be a prosperous new year. Join us for our year-end finale that will leave you both informed and inspired.
The Supreme Court says it will make a decision on whether to limit access to a key abortion drug. This marks the first major reproductive rights case the court will hear since it overruled Roe v. Wade last year. So we're going to talk about the legal implications and the medical situation with this drug. We're going to talk with Yahoo Finance's Anjali Kamlani and Alexis Keenan to get the legal side first. Alexis, what do we know about the Supreme Court's decision to hear this case?
All right, so this is the Supreme Court taking up the very narrow question of whether the FDA, when it started expanding access to mifepristone, and this is the first drug in a 2-drug regimen that is taken to induce abortion, whether when the FDA made these decisions in 2016 to move access from 7 weeks limitation to a 10-week upper limit, and also mail order, that came in 2021 in the COVID era so that women could get access to these drugs. They are made by a company called Danco. That's the brand name manufacturer of these drugs, so they're impacted. But what the court is going to take on is whether those two decisions were okay and whether that was within the FDA's authority. They're not going to take up the issue of whether the drug should be on the market at all, which happened all the way back in 2000. Now, the case comes, this appeal to the Supreme Court to even consider this issue comes from the Biden administration, also comes from Danco, the manufacturer, as well as the FDA. The other side of the case, the defendants here, they're the ones who won the case in the Fifth Circuit and also at the district court level. They are a group of independent doctors, as well as a group of a medical organization that represents doctors. They say that they should not be required to carry out abortions because it's wasting their resources and it's against their moral considerations to be performing when these procedures when women come to them in emergency situations.
And unsurprisingly, this all happened in Texas. Starting off, we know that that's been a key state with all of these discussions around abortion rights. So let's peel back what this is. As Alexis mentioned, mifepristone is one of 2 drugs given for abortion in early stages. Mifepristone and misoprostol, that's the other one. And that is actually already available because it's actually used for stomach ulcers or preventing stomach ulcers in patients. So there's no issue there. Mifepristone is a hormone blocker, and so that prevents the pregnancy from furthering. And that's the drug that is the issue. As Alexis mentioned, in addition to expanding how long it can be used into the pregnancy, the mail order part of it was really what also pushed this to the fore. We saw the pandemic regulations and approvals and sort of allowances really getting put on the table because this would expand use across the country as a result of overturning Roe v. Wade, which is the same Supreme Court. So that's really what's interesting at play here, where that sort of started this chain reaction of conversation of abortion access in the United States. We know that there have been state-by-state rules that have also impacted this, and really looking at whether or not the FDA can continue to allow this for the country.
Well, Anjali, I just want to quickly follow up with you on this because I'm curious about whether the outcome of this could have any impact on the FDA moving forward, because that's at issue with mifepristone. Are you anticipating that?
Well, that's the crux of the question, right? Is whether or not the FDA can just stand its ground and allow this to happen, and whether or not this will be a problem in the future. State by state, will that be impacted, or does the federal level get to maintain the access that has been stated?
All right, we're going to leave it there, but thank you for this. Yahoo Finance's Alexis Keenan and Anjali Khemlani as well. A new BlackRock Read On Retirement survey found that 40% of independent savers feel off target for retirement, with 45% of independent savers saying that professional management would help them feel more on track. Now, to help assuage that lack of confidence, BlackRock launched a suite of target date ETFs to give new avenues where investors might look at investing specifically for retirement. And so, are ETFs a good way to save for investment? And are they a good investment for those heading into retirement? As part of our ETF report brought to you by Invesco QQQ, let's bring in BlackRock U.S. Head of iShares Product, Rachel Aguirre, to discuss more. Rachel, thank you for joining us here today. We'll get to and you can talk about the ETFs here. I'm interested in the survey and the results that led you to create this new basket of ETFs.
Yeah, absolutely. Thank you so much for having me here today. And I want to start by giving you a number, 57 million. There are today 57 million Americans that don't have access to either a 401k or some type of work plan investing. And, as you mentioned, we recently surveyed this group of independent savers, and what we found was pretty remarkable. 40%, in fact, say that they feel like they're off track for retirement. And it's not surprising when you look into why. 47% of the same group say that they're leaning on cash to build their retirement nest egg. So they're missing out on some really critical investment opportunities that are required to achieve their financial goals. So we really believe this is one of the most pressing retirement challenges that need to be addressed. And while, clearly there is not a silver bullet here, we do believe that there's an opportunity for us to step in and really help with this. And that is where the iShares LifePath Target Date ETFs were born. We invented the Target Date Fund 30 years ago now. And so what we wanted to do was take that same IP and deliver it to your everyday investor in the convenience of an ETF. That's what this is all about.
Well, Rachel, it's funny. I saw you slightly shaking your head when you mentioned that so many people are keeping cash as their nest egg and hoping for that to work out in retirement, because we know, because we work in this industry, that that's not the right path forward. I'm curious, though, in your survey results, did you see anything else about the biggest mistakes people make when it comes to planning for retirement? We hear a lot about people who even do have 401ks not realizing that they have to invest the money that they have in there. Did anything like that surprise you or come up for you?
Absolutely. So cash is really the greatest enemy when it comes to achieving long-term financial goals. It is just absolutely necessary that people begin to invest in the market. And we know that that has been challenging in the recent history just because of the volatility that we've been experiencing in the market. But here's the thing. One of the things we like to say is that time in the market is so much more important than trying to time the market. It's nearly impossible to time the market. But if you are a long-term investor, you have to be in the market.
I'd like to talk about the difference between ETFs and mutual funds in general. You talked about your leadership in bringing target funds to the market 30 years ago. ETFs offer intraday liquidity, and there's other comparisons we can make there. There's also the fee structure. I'm looking at some of your fees. They range from 8 basis points to 11, which is low. But how does this compare with the mutual fund industry offerings of target funds that has been the norm for so many decades?
Sure, absolutely. And for us, it's all about choice, and it's all about meeting investors where they are. As you say, we've certainly offered target date style investing in mutual funds for many, many years, and will continue to do so. But what we have found is that increasingly, and end investors in particular, are beginning to choose ETFs as their vehicle of choice. And it's not surprising. It's as more and more investors experience all of the things that we love about ETFs, their convenience, their simplicity, their low cost and value, and of course, their tax efficiency. So in particular, if you are an investor who has money invested in a taxable account, this is really something to take a closer look at because of the tax efficiency that can be achieved in an ETF structure.
Rachel, I'm curious, as we start to wrap up here, what factors should go into a person's decision about that target date? Because I myself have my own target date retirement fund, and I have a little bit more time, so a lot of it is stock heavy. And of course, then we had the best 60-40 portfolio month in November that we've had in decades, so I was really bummed to look at my 401k after that news. What factors should consumers like me be considering when they're picking that target date, and what that does to the mix of what's in their retirement funds?
Sure. So here's the incredible thing about the iShares LifePath Target Date ETFs. They are so incredibly simple, and they move with you through your retirement investing journey. It's as easy as choosing the fund that most closely aligns to your target retirement date and make regular contributions. The rest is done for you. You can think about the retirement investing life cycle in 3 phases: grow, protect, spend. So when you're early in your career, it's all about growing your assets. So we begin with nearly 99% of our portfolio in a broad and diverse set of equities. Then as you enter your mid-career, as you begin to get closer to retirement, it needs to shift to protecting your assets. So there we begin to add high quality fixed income and inflation protection into the portfolio. And then finally, when you reach retirement, it's all about spending. You begin to draw on those assets. And so here you want your most conservative mix. And we shift down to about 40% in equities at this point. So you still do have access to growth, but you can spend from there. And so the beauty of these ETFs is that it does all of that. It moves with you and evolves with you as you move along your retirement journey. So it really couldn't be easier.
All right, Rachel. Well, we really appreciate you joining on us. Our thanks to BlackRock U.S. Head of iShares Product, Rachel Aguirre, joining us on ETFs and retirement there. Now, coming up, the quiet luxury trend taking over social media following the success of my favorite TV show of all time, Succession. But did that translate to sales? We're going to talk the luxury goods market. That's coming up next. While the luxury market appears to be slowing down, this year's growth rate is expected to be around half of last year's. U.S., European, and Chinese shoppers all tightening up their budgets this year. Retailers now overflowing with unsold products. Infamously, most luxury labels do not discount their unsold goods, unfortunately for us consumers, but brands like Prada, Gucci not selling much merchandise outside of its own boutiques there. So where does the excess inventory go? Well, many will hit off-price outlets, but even then, consumers won't find the cheapest prices. And that's what's really interesting, Jared, when we think about the status of the consumer. Are they able to keep up with the price of these luxury goods, or are we starting to see some trade down happening? But it still feels like, I don't know, there is some pricing power when it comes to the luxury goods space, but maybe that will start to wane a little bit heading into next year.
Yeah, you know what's interesting? Can we go to the Wi-Fi Interactive for just a minute here? Because I was tracking the luxury sector. This is our luxury year-to-date heat map, and we've got a number of winners here. But let me show you, because people are talking about the luxury Magnificent Seven at the beginning of the year. Here's LVMH, and you can see we had an incredible run here, but really had given back all of those gains and a little bit more, and then has bounced. It's not a story for all of them. Here's Hermès. You can see that's actually at the high for the year. But luxury overall just didn't quite get off the dime after the mid-year slump the way the Magnificent Seven did in the U.S.
Right.
All right, holiday shopping is underway. Are you in the market for luxury goods? Based on the year that luxury giants have been having, you probably aren't, but maybe it's time to buy a luxury luxury as an asset. In Rebag's annual Claire report out today, some luxury products have retained or even grown in value over the last year. And for more on this report, Charles Gora, Rebag CEO and founder, he is here today. And thank you for joining us. Just your firsthand, I guess, 50,000-foot view of the luxury market this year. I was making some comments that they were kind of toe in toe with the Magnificent Seven, but demand kind of fell off. What's your take on the resale in the U.S.?
Hey, good morning. Glad to be here. I would say to some extent the resale market is a reflection of the luxury market, and you kind of have two converse trends, two opposite trends in this market. You have, if things slow down on the luxury first-hand market, it means, there's more tension on consumer there. And so maybe there's someone, on our end of the resale world who's finding essentially access to a cheaper version of that product. So that's some of the dynamics that you can see. And you also see the reverse, which is if things are tense, at people's budgets, etc., you can see a lot more sellers. So we are a consequence of some of the trends that you see in the first-hand market.
I'm curious, when you think about the luxury market more broadly, how you're thinking about some of the headlines that we've heard recently about the other players in the space. I'm thinking Farfetch, for example, considering going private after sales just haven't stood up to the degree that they were coming out of the pandemic when we saw a lot of spending in this space. How much does that concern you about the longevity of your business moving forward?
I mean, certainly problematic for the whole space. I would say Farfetch is, they're more in the first-hand world, but, we are also part of that digital luxury world. And, it's obviously easier for us if everyone succeeds. I would say Farfetch is, a lot of the Farfetch story is an international story that has to do with China and a lot of geographies that, we're not directly impacted with. And frankly, they've had their own problems of, taking the company in many, many directions. So I would say not directly related, but you're right. What is common is there are some tensions in what you could call unit economics, right? And some of that is for the last 2 years you have, right? And some of that is for the last 2 years you have a combination of softer demands. You have a lot of combination of more competition. You have a combination of increasing customer acquisition costs for a lot of digital players. And you have, more channels available for luxury, companies. So I think all of that put together makes it more difficult for everyone to stand out, and you have to find, a way to get this done profitably.
What about the problem of counterfeited goods? This is something that's been a thorn in the side of luxury makers for decades, but especially with e-commerce and the ability to, manufacture counterfeit goods has only increased. We've seen this become a bigger problem. How does your company deal with this specifically?
Yeah, it's a huge issue. So counterfeits have always been an issue, and I would say they're increasing, mostly because what we call super fakes are essentially becoming better and better. So it's always a game of virus versus antivirus, and you always have to upgrade your game. So the way we figured it out at Rebag for the past decade that we're in that market is every item that we buy and sell transits through our own properties, our warehouse, our store, and we see it in person and is assessed physically. And so we've trained a team of experts and all sorts of digital tools that we use for that. And then we own that product with all the reinsurance and trust and returns and guarantees that goes with that. I think a lot of the problem you see on authentication have to do with sort of digital companies, if you will. And the problem is authentication is extremely hard to assess in a digital way. And the best way is really in person at this stage.
Well, Charles, we're going to have to leave it there, but I will tell our audience that we know from your data, the Telfar bags really seeing a lot of sales there. So if you're still looking for some holiday gifts, maybe a Telfar bag for folks. Thank you so much, Charles Gora, Rebag CEO, for joining us. We do want to hit on some developing news this morning. Etsy shares taking a hit after the company laid off 11% of its staff. The CEO, Josh Silverman, saying the cuts were needed to bring down expenses as the company is adjusting to a very challenging macro environment. environment. The Etsy layoffs coming after toy maker Hasbro cut more than 1,000 jobs earlier this week. They cited softer sales during the crucial holiday season. That was about 20% of their staff, Jared. And we're also hearing news about Citigroup offering partial early bonuses to encourage staff departures. We heard something similar from Wells Fargo. I mean, unfortunately, 'tis the season of these layoffs and cost cutting heading into the new year, right?
Yeah, unfortunately, we do see this heading into the new year in December. There's a head cutting season, if you will. And also companies like Citigroup are just looking to reduce some of their expenses. They'll make an offer and maybe people will take it here. I think it speaks to the larger issue of employment. And we saw the tech layoffs kind of take off a year and a half ago. And there really wasn't a lot of fallout or follow-up from that. You know, outside of the tech sphere, the job market has been incredibly strong. We got the latest data from the government on the BLS last Friday. So the jobs market has been rocking and rolling here, and we're just getting these little incremental bits of news. So industry-wide, we see cracks in manufacturing and construction first. Haven't seen that. Tech layoffs, those tend to come first as well. We got those and a few of those in the rearview mirror, but hard to speculate what 2024 brings.
Yeah, it's interesting, too, that they talked about the macro environment when we've been talking about spending staying strong, Jared. But as you mentioned with the Taylor Swift economy yesterday, maybe that's credit delinquency related.
Yes,
more
and
than
hopefully the Taylor Swift, the Taylor-made economy doesn't become the Taylor-tanked economy in 2024.
Ooh, brand that. There you go.
Thank you. Coming up, Netflix finally opens up. The streaming giant is letting all of us behind the curtain on its viewership. We're going to talk about why up next. Netflix has unveiled its most comprehensive engagement report to date, giving viewers and competitors the inside scoop on what people are watching. But what does this mean for Netflix's content strategy moving forward? Yahoo Finance's Alexandra Canal joins us with more. Allie, what's the deal here?
Yes, I mean the most comprehensive report, not just from Netflix, but really any streaming giant that we've seen. From the investor perspective, I'm not sure it's going to move the needle too much, at least right now. We didn't see much of a stock reaction after the release of the report, but certainly for creators, for Netflix partners, even for advertisers, this is incredibly useful information. And just parsing through some of this data here, a few things stand out to me. Number one, all of the top titles on Netflix are original series and films. We know that Netflix has about 45% of licensed content, but it's that original content that's really making a big splash here. You have shows like The Night Agent, Ginny and Georgia, Wednesday, all doing incredibly well. Now, just a caveat, this is 6 months worth of data. So this is a biannual report, and that could change depending on when shows are released and things like that. So something to keep in mind. Another thing that stuck out was outside of the US, the biggest hits were from South Korea. Netflix has invested $2.5 billion in that territory. Obviously, they've seen a lot of success from Squid Games, but there's other shows and series from South Korea that did well as well. And if you think about unscripted content, especially local language unscripted, that's an untapped area for Netflix to really dive into. And that's something that co-CEO Ted Sarandos has talked about at length. He also said animation is another untapped potential area that Netflix could explore, saying that 8 out of the top 10 most streamed movies ever are animated films. So perhaps we'll see some more animated content there. And lastly, I mentioned how Originals has done well, but on the licensing side, we've seen Netflix be really successful there. Shows like Suits have just exploded. Suits popped up several times in this report. I think the next report, we're going to see that even higher, considering it was the summer that we really saw Suits explore. I did ask Ted Sarandos on a press call prior to the release of this data whether or not they would ever consider licensing Netflix originals to competitors, especially as licensing picks up steam. He told me pretty much no, that they don't think it would have the same effect. They have a large subscriber base. They have the ability to create some search and discovery that they don't believe would be beneficial to them moving forward, but you never know. So there's a lot happening in this space, and I think it's certainly going to set a standard for other media and streaming giants to possibly release more of their viewership data, which we haven't really seen.
No, but we are out of time now, so we got to say goodbye to
Yes.
you, Callie Cox. Thank you for that. And let's do a final check of the markets. Let's take a look at the Wi-Fi Interactive. We got the Dow just in barely positive territory, up about 3 basis points. S&P 500 up the big hits, but that's only 12. And the NASDAQ also in the green. Russell 2000, the small caps in the red here. And let's just take a quick sector look, and we can see utilities and real estate are the 2 big winners. Materials and consumer discretionary are the 2 biggest losers. That is it for now. I'm Jared Blicker with Madison Mills. Thank you for watching.